the U.S. economy really was massively resilient.
The labor market is a different labor market.
The unemployment rate is moving higher gradually.
It's frozen, but not melting down.
We're going to start to see some signs of the labor market stabilizing over the next several months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists are looking for a firm jobs number and a drop in unemployment as the White House is bracing for a possible ruling on Liberation Day tariffs. President Trump is pushing Fannie and Freddie to buy $200 billion in mortgage bonds. The president looking to boost the economy.
All I can say is tracking this news cycle is kind of like watching pinball at a very close speed, trying to make sure that you understand where the ball is going at any given time. There are some broader themes here. The focus on the economy, you are right to point out. With respect to the mortgage market, how much is housing affordability going to remain one of the drumbeats heading into the midterm elections, and how much is this going to end up focusing on Fannie and Freddie? Yes, and buying bonds. $200 billion has to be put in the scope of $9 trillion for the mortgage bond market. At the same time, the Federal Reserve has to come back into focus.
The president's had quite a week, hasn't he?
He has.
You know, it's a long list of things he's done this week. I've picked out three. So the president went after executive pay of certain firms, went after capital returns, he's gone after investigative housing, and he's added more to the list going into the weekend.
I feel like we actually are this week, the first full week of January of 2026, drinking from a fire hose. The list is unending when it comes to what the president is trying to do right now and really use the weight of the White House for it. We talked about housing. We talked about the fact that he's also going to be meeting with oil executives today. He says that they're going to be investing $100 billion. 14 of them are lining up. Not quite sure that's the readout I'm getting from the shale patch right now, but the president says these individuals want to invest. On top of that, he's talking about a lot of foreign policy. He's going to be meeting with the Venezuelan opposition leader next week. And at the same time, as Iran has protests overnight and is absolutely blackout right now in that country, he is saying that he's putting them on warning if they go after any of these protesters.
We need to sharpen our focus a little bit, so let's focus on one thing. 8:30 Eastern Time, the jobs report, and the attention firmly on one data point, one metric, the unemployment rate. Unemployment set to come back in just a little bit later this morning from 4.6 to 4.5. Does that shut the door on the rate cut debate at month end?
To me, this is the ultimate question, right? How much does this end up being a bear case for the bond market and seeing a sell-off that does continue because people have been expecting any kind of further weakening in the labor market to allow the Fed to move as soon as January 28th. If you do get the unemployment rate ticking down, how much dissent do you have in the Federal Reserve? Do you see those fissures in that much more focus? And how much more is President Trump incentivized to announce a different Fed chair in short order? It could come on the front end or the back end of Davos, that's according to Treasury Secretary Scott Bessent.
What he said in the last 24 hours, but I feel like we've been waiting for weeks and been told the same thing is coming. It's coming, and apparently it's coming now in the next 2 weeks.
You could say weeks, you could say months. We've been talking about this for a long time.
It was supposed to be in the fall.
Yes, exactly.
I was told in April it's supposed to be in the fall. Also interesting, though, we do have officially what the names are, and I thought Rick Reeder had sat down for his interview yet. He's the only one that's pending an interview. Maybe that's why they're unsure whether it comes before or after Davos.
If you're just joining us, welcome to the programme. Lots to get through this morning. Bond yields a little bit higher, up by 2 basis points at the top end or close to the top end of the recent range, very close to 420. 418, call it 419 this morning. Coming up this hour, we'll catch up with Stephen Major of Tradition, with stocks holding steady. The former senior White House trade advisor Kellyanne Shaw on Supreme Court opinions, and Claudia Sahm of New Century Advisors looking ahead to the latest jobs data. We begin this hour with stocks on hold and the dollar at a 1-month high ahead of the payrolls report later this morning. Stephen Major of Tradition writing economic data relative to expectations has softened. There is fundamental support to keep lowering the Fed funds rate to a level below where the forwards are currently implying. Stephen joins us now for more. Stephen, welcome to the programme, sir. It's always good to see you, and congratulations on the new seat. Let's talk about the data this morning. How relevant is the jobs report at 8:30 with your opinion in mind?
Well, I think your setup said it all, John. There's other stuff going on, isn't there? So there's the fiscal news perhaps coming through later, and everything else that's happening globally. So it's just one data point, and I think you've covered it pretty well. Regarding this one, what really matters is the evidence on about what all this does for wages, because I think there's been a clear trend these last few months where the path of wage growth is consistent with something nearer to the 2% inflation target. So what you want today is something that doesn't disrupt that, really. Of course, it's complicated because you've got the labour pool being affected by migration factors, and you've got some softening of demand for labour that's been evident in previous months. Overall, it's all very well looking at the unemployment rate and the payrolls number, but it's the bigger picture, how this fits into the bigger picture that matters.
Well, Steve, the bigger picture, I think, for many is that we've seen a notable increase in slack, captured by several data points. You point to wages, you can point to the unemployment rate rising more recently as well. There is a take on Wall Street at the moment, Steve, and I wonder if you'd push back, that if things stabilise, particularly with things like the unemployment rate, it closes the door on interest rate cuts. Do you see things differently for the year ahead?
I don't know about that, John, because so first of all, given all the things that have been happening, and you listed the surprises, the shocks that we've been experiencing these last few weeks, given all of that, would you have believed that the 10-year Treasury would have been in a range of 6 basis points, I'm told by my colleagues downstairs, 6 basis points this year, six whole basis points? In fact, it's been in a tight range for quite some time now, even before the start of this year. So, I think that the bond market's holding in pretty well. If you got a strong data release today, something that indicated the economy was much stronger than we expected, I think the cynics out there might question whether the data was correct, in the same way that you could say if it was exceedingly soft. I think it's the broader trend that matters. You've got to smooth these numbers out over a period of time. I think the trend and the path is quite clear towards lower rates, and therefore there's an asymmetric bias in place. If you get a shock that says that the rates aren't going down, I don't think it's going to bother the market that much, but we're skewed towards opening the floor for rates and seeing how far they can go down. I don't see that many people talking about rate hikes anymore. It's only a few months ago that was being mentioned on shows like this.
It seems like, Stephen, this is no longer a data-dependent market, as you just laid out, at least not a data point-dependent market, just because people have so many questions around the data. This is potentially a market, though, that could be roiled by events. And you mentioned some of them, including the IEEPA ruling that could come as soon as today. What kind of effect would it have on the bond market if the tariffs passed under the IEEPA rule in the United States were to be repealed, pushed back in any kind of way?
Okay, that kind of scenario is going to blow us out of that 6 basis point range. And the question is whether we would close still outside of the range or whether we'd still be outside of the range next week. Ultimately, we're looking at whether there is a path, I'm using that word path again, towards a fiscal number that is manageable. I mean, is it possible that the deficit is within a reasonable level? Now, of course, there could be some disruption to the president's plans, and it's clear there's a risk here. But ultimately, the bond market's going to clear. The auctions are going to get done. There's a question about at what price and at what cost. Because the bond market's going to get done, I can assure you of that. The question is whether it's going to come at the expense of some other asset class.
Yeah.
That's really the issue, right?
Stephen, you keep talking about the 6 basis point gap, and you're right. I mean, even when you look at the move, the forward implied volatility index in 10-year Treasury yields, it's incredibly low. You aren't necessarily seeing much expectation for disruption. How do you know that this is resiliency and not complacency?
Yeah, look, that's a fair point too. Maybe we're all just so beaten up and already exhausted with the shocks. I'll give you an anecdote on this. You're putting together my most recent piece. Like many analysts, you tend to go through it at the weekend. So I'm sitting there on a Sunday looking at the text. I'm thinking, oh no, with the news flow last weekend over Venezuela, I was thinking everything I've written here is irrelevant. But I came in on Monday morning and I was still able to publish it. Now, how is that possible? How could I have been so wrong with my judgment on the Sunday compared to the Monday? And I think that most of us are experiencing the same thing. Anyone who's involved in this market at the moment. So it could be that we're complacent, but it could also be with the fact that we're resigning ourselves to the reality that rates aren't going up and they're probably going to go down. So, as I said, I think the data is consistent with dates going down towards where the forwards imply and maybe less. And with some of the changes coming at the Fed, I would suggest that the balance is tipping to rates going even lower.
Well, a lot has already
we'll wait and
happened.
see.
A lot has already happened from Sunday, Stephen. The president this week has really taken a focus on the housing market. Even if the Fed continues to cut interest rates, is that going to help the U.S. housing market? Will that help mortgage rates?
Look, so what proportion is that money of the total stock of mortgages? It's not that high, is it? I haven't run all the numbers yet, but we're talking about a few $100 billion in a multi-trillion market. So I don't know how much of a game changer it is. Ultimately, getting the 10-year rate down towards 3 rather than 4 would be one of the best things that could be done for the housing market right now. So I guess the intervention that's just happened is going to help, but I haven't run the numbers yet. I don't know whether it's going to have a major impact.
I actually mean if the Fed cuts interest rates, is that really going to meaningfully help the mortgage market?
Thank you. I thought you were referring to the intervention for Freddie and Fannie. Now, if the short rate goes down another 100 basis points, the whole term structure is going to come down. The 10-year on current form isn't falling as much, but it doesn't mean to say it won't still go down. So it depends what the delta is between the rate cuts and the 10-year. I would suggest if policy rates go towards 2% or even less, then you could imagine that 10s are going to have a 3 handle and probably low 3s.
Final question, Steve. What's more likely at year end? That the 10-year yield is at 3% or West Ham is playing Premier League football?
That's an impossible one to answer. Look, John, based on the fact that West Ham are 7 points adrift, it's pretty obvious where the probabilities lie there. But you think things can change. It looks like a close call between the two. And I'm not gonna give you an answer if you don't mind.
That was unfair of me, Steve. I apologise. It's good to see you, buddy, as always. Stephen Major of tradition on this bond market and a sprinkle of Premier League football and why he believes the fundamentals are set up. They will support further interest rate cuts.
Yeah, and right now the idea of whoever is going to replace the current Fed chair will only make it more so since that will only bias rates lower.
To Steve's point, what a tight range we've seen so far year to date.
I keep going back to this question, is it resiliency or complacency? And ultimately, I think everyone's saying resiliency because of all of these factors. Let's see if there is anything that can break through the noise. And it is noise. My goodness, how many different topics we're talking about. So
far year to date, on a closing basis of 5 to 6 basis point range on a 10-year maturity. The yields are higher this morning by 2 basis points. Let's call it 419. With an update on stories worldwide this morning, let's check in with Yahira with your Bloomberg brief. Hey, Yahira.
Hi, John. President Donald Trump is preparing to meet with 20 oil executives as he looks for help to rebuild Venezuela's energy sector. The attendees include fracking pioneer Harold Hamm and representatives from Chevron, ExxonMobil, and ConocoPhillips, and more. The administration's plans to rebuild Venezuela's oil sector could cost up to $100 billion over the next decade. Meanwhile, President Trump directing Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to bring down housing costs. The president claiming the move will drive down mortgage rates, some estimates suggesting a drop of at least 1/4 point. And this just in, Meta announcing new deals to power the company's AI data centers. The agreements could total more than 6 gigawatts of nuclear power, enough for about 5 million homes. Meta says it will purchase electricity from Vistra, Oklo, and TerraPower. The deals would make the tech giant one of the largest buyers of nuclear power among the hyperscalers. That's your Bloomberg brief. John.
Amazing. Those deals keep coming. They keep piling up. Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the programme, the push for affordable housing.
What we want is affordability to get better. What the Fannie and Freddie buying will do is compress the spread between mortgages and Treasury bills.
Up next, we'll catch up with Jeannette Lowe of Strategas, live from New York City. Good morning. The rally hitting pause going into Friday, just below Tuesday's all-time highs. This morning, just about unchanged. Treading water going into the payrolls number at 8:30 Eastern Time. Futures this morning up by 0.06%. On the Nasdaq up by 0.14. In the bond market, 2s, 10s and 30s shaping up as follows. We talked about that very tight range on a 10-year maturity. Yields at the top end of that range for the year, 418.50, higher by 2 basis points. We're in a very different position to start the year compared to where we were last year. 3-month moving average for payrolls coming into 2025, north of 200k. 3-month moving average coming into 2026, just north of 20k. That's a very different jobs picture for this country.
Yeah, and a very different expectation about what kind of break-even rate we need to really keep America employed, right? So that's why the question is really going to be the unemployment rate, because ultimately we don't have a sense, based on the demographic shift, of what a good or bad labor market number really is.
We're hoping that number stabilises a little bit later this morning, and the overwhelming expectation from Wall Street, at least, is that you'll see some of that at 8:30 Eastern Time. And the surveillance this morning looking elsewhere and the push for affordable housing.
What we want is affordability to get better. What the Fannie and Freddie buying will do is compress the spread between mortgages and Treasury bills. So Fed is currently selling mortgages. Fannie and Freddie can offset that buying.
So here's the latest this morning. President Trump pushing Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds as part of the White House's efforts to lower housing costs. Joining us now from Washington is Lauren Dezensky. Lauren Dezensky, welcome to the program. Just set us up here. What has the president announced and what is he trying to achieve?
Certainly, President Donald Trump announced that Fannie and Freddie are going to buy $200 billion worth of mortgage bonds. This is really all a part of Trump's affordability push. The goal here is to push down mortgage rates. And coupled with his announcement that he's going to block institutional investors from buying single family homes, this is all in his effort to make buying a home in America more affordable. The part that's interesting to me is that he's planning to talk about this at Davos later this month, which in terms of a domestic political message might not be the right venue for it. But for Trump, he's going to talk about whatever he wants. And affordability really is the word on his lips this year so far.
Yeah, Lauren, I'm with you, and I think everyone is. The backdrop is a curious one, but we'll get into that another time, maybe next week. The Treasury Secretary's words, I think, are interesting for me. When he points out something we know, but he says it explicitly, that the Fed is currently selling mortgages, Fannie and Freddie can offset that buying. Is that something we need to keep in mind as they're still going through the interview process to replace Chairman Powell?
Certainly. I think that perhaps this is a reflection of the direction of rates that Trump may or may not see from his future Fed chair candidate. Obviously, this process is a little opaque, and I would not want to weigh in too far over my pay scale here. But, you know, he's the Fed and the cost of everything. Like, this is something that clearly is so important for voters, as they have said at least this past year. And coming into the midterms, Trump has made very clear that he's thinking about his political survival. He told Republicans this week that if Republicans don't keep control of Congress, he might get impeached. And so this talk about rates and affordability and everything comes into that as well.
Hey, Lauren, it's good to see you. We'll catch you with you later this morning. Lauren Dezensky there of Bloomberg down in Washington. There's one good reason I can think of for doing this speech in Davos, Switzerland. When you look at the agenda for the next 2 weeks, there's a panel that week, I think it's on the Wednesday, and it's about jobless growth. And I think jobless growth at this point is so important for the people that are attending that get-together. Because if you think about the themes they've focused on for years, for decades in Davos, Switzerland, we haven't focused enough on just improving people's lives. It's been focused on these massive big-picture issues, the nice-to-haves, and I'm sure we'll get into that in 2 weeks' time. And there is a warning, I think, for a lot of these executives who are chasing these big goals and generating lots of profits, is that a lot of people at the moment are being left behind. And if you don't do something about it, you're going to find out at the ballot box.
You raise a great point. The idea that that President Trump having a firebrand speech with populist overtones at the key capitalist event of the world, frankly, sends a pretty big message back home that he's willing to stand up to power. So you can expect that there might be a real overtone of that, or, you know, really that will be the subtext, pretext, and the text of his speech.
Corporate profits up here,
exactly.
Payrolls growth down there, and everything in between. There's a lot of tension for society. Joining us now to discuss is Jeannette Lowe of Strategas. Jeannette, wow, what a week. What a start to the year. We've seen so many announcements coming out of the White House and from the president. What are you focused on and what are you telling clients?
Yeah, this has been quite a start to the new year, and there's definitely a lot of changes afoot. I think one of the things that's really important here is that, obviously, as you guys mentioned in the last segment, the president is much more focused on affordability. This is a midterm election year. He is looking ahead to the potential loss of Republican control in the House of Representatives. So there's going to be a big focus on things like housing and electricity prices and things of that nature with regards to affordability. The other big story is obviously that in 2025, we had a focus on more austerity. It was about tariffs. It was about a delay of what was the tax benefits in the One Big Beautiful Bill. So you had those changes made, but you didn't change people's withholding. So that will now come out in 2026. The Fed held off on cutting rates until the end of last year. You know, have the Fed cutting rates. And we also see that we're going to get some financial deregulation going ahead into this current year. So you have a lot of austerity that was going on in 2025. As we move into 2026, we see a lot more austerity with the business and the consumer tax cuts that are coming with this financial deregulation and with more of the monetary policy easing coming from the Fed. So we have a lot of pieces there. And then, of course, obviously, we're also focused on what's coming potentially out of the Supreme Court this morning and what that could have as an impact on Trump's tariff regime and whether or not that will be disrupted.
Jeannette, when it comes to the Supreme Court today, what's your base case that they will strike down IEEPA?
Yeah, I mean, that is our base case right now, is that they will strike down the IEEPA tariffs. So this will not impact the Section 232 tariffs, which are things for steel and aluminum and autos. So all of those will remain in place. But the tariffs that were imposed as reciprocal tariffs and the fentanyl tariffs, those do look like they are in danger here. The big question will be, could there be nuances that comes out of the Supreme Court? Could they keep the fentanyl tariffs in place because that represents more of a national emergency than the reciprocal tariffs? Will they decide whether or not there needs to be refunds for companies? Obviously, we've seen a slew of companies file in the Court of International Trade to make sure that they can still get a refund. That will be important. And whether or not how long that process might take. And it may not be that we even know right away, because it could be that they remanded back to a lower court. So there could be a lot of tariff uncertainty. But one of the things that we're telling our clients is that however the court decides, the court is not deciding how Trump can impose tariffs. I mean, it's deciding how Trump can impose tariffs, not whether he can do so. So even if they rule against the administration, there is a backup plan that the White House has. And essentially, in a couple of months, it may take 5 or 6 months to get there. But we think that the administration is going to put back into place essentially all the tariffs that we have currently, even if there is an adverse decision for the administration.
Jeannette, one story we didn't talk about, but 17 House Republicans joined Democrats yesterday extending the Obamacare enhanced subsidies. Do you think that's actually going to pass in the Senate?
Yeah, I mean, there obviously has been some movement towards getting a bipartisan deal on this. There was the expectation that the discharge petition, that was the move that got this bill to pass in the House yesterday, that was going to come to pass. Obviously, we don't expect the Senate to do a clean extension. We do expect them, if they're going to move this forward, to come up with some sort of compromise, maybe a 2-year with some reforms included. There definitely does seem to be some momentum. You've had some mixed signals. Obviously, Trump said earlier this week that he was willing to, provide some flexibility with regard to abortion and the Hyde Amendment. So there does seem that there's this option to get something done, and we'll have to kind of see once this now moves into the Senate. Obviously, again, with affordability being a big issue, a lot of the Republican House members that voted for this extension were members who are vulnerable in the midterm elections. And so I do think there is going to be some concerted effort to at least try to find a solution as we move forward.
Hey, Jeannette, thank you. Good to catch up. Jeannette Lowe there of Strategas. It is January 9th. We've got a whole year of this still to come.
Ooh, sounds like a lot of fun. It seems like everyone's got a lot of energy for this one.
Coming up on the program, the former senior White House trade advisor Kellyanne Shaw with Supreme Court tariff opinions pending. Plus, Danny has your morning movers. From New York City, you're watching Bloomberg TV. Equities just about positive by 0.1% on the S&P 500. The payrolls report 2 hours away as we count you down to the opening bell. Set up for a decent week of gains actually on the S&P so far, just below those all-time highs we printed on Tuesday. On the Nasdaq 100, positive by 0.2. The Russell doing nicely recently as well, up by 0.2% for the small caps. Turn to the bond market. At the very front end of the yield curve, 2-year bond yields higher for a fourth consecutive session, just bleeding a little bit higher, but still anchored around 350, 350.51, yields higher by 2 basis points. The 10-year at 418.50. I'll ask a question that Bramo would really like. What's more important this morning? Jobs at 8:30 or potentially Supreme Court opinions a little bit later?
Supreme Court opinion a little bit later, because right now people have such skepticism and exhaustion around data roulette that essentially whatever comes out will get nullified in terms of skepticism and overlays if it is a significant number that does surprise markets in any capacity. I could be wrong, of course. However, the fact that IEPA could potentially be overturned by the Supreme Court, we don't know whether those rulings will come out, to me indicates a potential black swan moment for people who have been counting on this revenue to really support the balance sheet of the United States.
I agree. We could see a tremendous amount of chaos for this administration as they try to line up the next legal avenues to make sure that they keep tariffs in place, but also for companies. Remember, if you did not file a litigation with the trade court, there is potential that even if IEPA strikes this down, you will not get your refund. So a lot of companies actually might be taken aback and on the back foot when it comes to this, and they are not prepared for potentially to reap the money they are owed.
So when we're thinking about where surprises come from, you've got to think about what we're priced for. Aren't we priced for that outcome at the moment? Wouldn't the bigger surprise be that actually it was held up and we keep these tariffs?
You know, I'm laughing to myself because I think Stephen Major nailed it when he said you could totally change your narrative based on the headlines and you come in and maybe it's 2 basis points away from it. In other words, you're not going to necessarily see big moves because everything seems to cancel itself out and nothing seems to matter.
And also, we're just going to start putting in, instead of IEPA, 338, 122s, 232s, there will be tariffs.
I think Steve just wants to break out this very tight range on a 10-year bond yield, and we're right in it at the moment, 418.50 at the top end of that very tight range to start the year. Let's turn to foreign exchange. Quite a week for the dollar, the best week since November, and another week of gains, another week of dollar strength. Euro dollar down to about 116 so far this morning. That currency pair negative by around 1/10%. As we count you down to the cash open, let's get you some morning movers. Lots to talk about. Danny has more. Hey, Danny.
John, you took my words. It's already shaping up to be a very busy morning. Announced less than 30 minutes ago, Meta signing a multi-gigawatt power nuclear deal. This will mean that Meta becomes the biggest buyer of nuclear energy among all of its hyperscaler peers. It's going to be buying that energy from already existing nuclear companies like Vistra, like Oklo. So you can see those shares both surging in the pre-market trade, nearly 20% for Oklo. Elsewhere this morning, we're also seeing all the mortgage-related companies. Those are also surging the pre-market after Trump yesterday saying that he's directing Fannie and Freddie to buy $200 billion worth of mortgage-backed bonds. You're also seeing those rally this morning, too. All part of an affordability push. The president saying that it would help lower costs for mortgages. So Rocket, loan deposit, open door technologies, all moving. In the case of loan deposit depot up 18.4%. Finally, some more Trump-related movers this morning. The president putting out on Truth Social that Intel, that he had a meeting with Luc Boutin and it went well. They're making good progress. Again, the administration has been committed to taking a 10% stake in Intel. Right now, it's about 5.5%, but anyway, Intel up 2.7% in the pre-market, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. Sometimes you have to take pause and just reflect. How many of those individual stocks are moving on presidential announcements?
It's really quite unbelievable. I mean, if you think about the oil majors, if you think about the defense contractors and what's been going on there, if you think about the mortgage builders, the mortgage providers, what's going on there, and then if you take a look at a couple of random tech companies that might come into play, I mean, how do you get involved in this as an investor? It just really raises a lot of questions.
Intel closed down yesterday because as soon as the president put out that truth, I checked the stock. And then in the aftermarket trading, it was up 2%. And there is skepticism, and you see this a lot on financial Twitter. Are there people that are privy and aware to this information and then using it to their advantage?
Yeah, it's not good. Let's put it that way. We'll have more on that a little bit later. On our radar this morning, the Supreme Court issuing its first opinions of the year today, including a potential landmark ruling on President Trump's Liberation Day tariffs. Justices will decide if the White House bypassed Congress to unconstitutionally tax trade. Elsewhere, nearly 20 oil executives gathering at the White House today. Industry leaders meeting with President Trump to discuss Venezuela's oil production. The lineup including representatives from Chevron, Exxon and ConocoPhillips. And finally, President Trump also issuing a warning to Iran amid nationwide protests. Trump saying the U.S. will, quote, hit them very hard if authorities begin killing protesters. Iran is restricting internet access, with thousands taken to the streets across the country.
So a big question here about whether President Trump is involved in this with some social media. This is what actually Ayatollah Khamenei is arguing. On the flip side, it does seem like there is this groundswell of support of people protesting and trying to overturn this regime. Look, when we were talking with Amos Hochstein, he said this was the next hotspot. And actually, some of the success in Venezuela would just engender the U.S. and Israel to go in and potentially bomb Iran. So a lot of people are saying, is this the pretext for them to do that?
The one thing I will say on the military side, the defense posture in the Middle East hasn't changed just yet. And that would have to change if we were going to go back into Iran, if the president was going to take some sort of military action. I think what is important to notice, though, we do see Iranian authorities frequently try to do this. They shut down the internet. They shut down your ability to make phone calls and phone access when they are trying to quell protesters. So no surprise there that we're seeing this sort of blackout in Iran. We should note this is, though, the biggest since 2022 against the Ayatollah. He's 86 years old. But in 2022, it didn't work. So the big question is, will it work this time?
That is the hotspot on the map at the moment. Let's turn back to trade. The Supreme Court set to hand down opinions on the legality of President Trump's tariff agenda. A ruling could come as soon as today, forcing the White House to recalibrate its approach to tariffs while refunding potentially over $100 billion. Joining us now to discuss is the former senior White House trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the program. Now, of course, we don't know if we'll actually get this decision later on this morning, but overall, what are you expecting?
Well, good morning. And certainly everyone is waiting with bated breath to see if the 1 in 19 case that comes out today is, in fact, going to be the IEEPA tariff case. But what would expect to happen is for everyone to take a moment and digest what the court has to say, both on the private sector side as well as the government side. And in fact, I wouldn't necessarily expect the president to announce his plan B right away. I think the administration would need time to figure out what options are available to the president, tee it up to him for a decision, and we could see something come, say, next week.
So when it comes to what options he does have available, I talk about these sections all the time. Can you actually walk us through what is going to be the most likely scenario you could see coming out of USTR?
Sure. And the administration has talked a lot about this, the fact that tariffs are going to be part of the president's strategy. They're not walking away from their tariff program. And some of the other options that they have legally include the numbers that you listed earlier, Annmarie. So Section 122, which is really about balance of payments, that gives the president the authority to impose tariffs of up to 15% for a period of 5 months, at which point Congress needs to vote to keep those tariffs in place. You also have Section 338 of the Trade Act of 1930. It's a statute that's never been used and hasn't really been threatened since the 1940s. That would arguably give the president the authority to impose tariffs of up to 50%, so he could effectively replicate the tariffs he has on every country overnight and reimpose those under 338. But again, it hasn't been used in its almost 100-year history, so not a lot of precedent there. He could also use these sectoral tariffs, so these Section 232 tariffs like the steel, aluminum, pharmaceuticals, semiconductor tariffs to try to do a product-by-product approach. I think that's pretty messy. And then he could also do individual country investigations under what's called Section 301. And those are the tariffs that we currently have in place on China. We've got an open investigation on Brazil. He doesn't have a limit if he uses 301 in terms of tariff levels, but the challenge is those investigations are going to take at least 5 or 6 months to complete. So if he does that on a country-by-country basis, which is what a lot of people in Washington suspect he might do, the real question is what tariffs are going to take place in the meantime? What's the bridging authority? So we could see kind of a mix and match of some of these measures.
Do you expect countries to be lining up once again if the Supreme Court strikes down IEEPA and they're preparing for the president to have to go back to the negotiating table?
Well, look, I think that part of this will be a country-by-country decision. And I suspect that most of our trading partners will honor the commitments in the deals that they've made, or they will just, be okay with the status quo in the intervening months, because there is that threat. Almost assuredly, the president's going to reimpose these tariffs under some authority or another. And so there might be some deviations. You could see Europe, for example, that still hasn't passed that implementing law to reduce its own tariffs as part of the deal that it agreed to way back in July. I've heard on the European side that they may not move forward if the president, in fact, loses his IEEPA case, which would put us back in a trade war with Europe. So we could see some examples like that. But I think for the most part, countries are going to hold to their commitments.
Kellyanne, the reason why it's always great to hear from you is because you've been on both sides of this, right? You've been in the White House, you've done these negotiations, and you currently talk to a lot of corporate clients and others to give them advice about what to expect. I suspect that there is a degree of exhaustion after a year of uncertainty, and that a lot of people are not looking forward to another cocktail of tariffs. If this is the year where people are supposed to rebuild their supply chains, how does a new overview of tariffs potentially complicate that?
Yeah, I think that everyone is exhausted. I think I heard from about 3 clients in total over the break, just by sheer exhaustion. So, what does it look like this year? Last year was about breaking the global trading system, changing the way we trade with every country on earth for every product on earth. I think this year, from the administration's perspective, it's about rebuilding and recalibrating, meaning if you took a global sledgehammer to the trading system, you patched it back together in 2025, 2026 is about fine-tuning it, making adjustments where necessary, but not these big tariff swings. Now, of course, the Supreme Court case is the elephant in the room, and that could disrupt the plans for 2026, depending on which way the court comes out. But I do think, particularly towards the second half of this year, we're going to see more recalibrations as opposed to these giant swings. I think the tariffs are pretty much where the president wants them right now, and it's more about adjustment.
Kellyanne, we've written stories at Bloomberg about how many companies have lined up and put the paperwork in to try to get some of the refunds should the IEEPA tariffs be overturned. How many that you talk to have plans to start that groundwork just to get a foot in the door to start claiming their refunds that haven't yet done so?
Well, what I'd say is we are seeing cases filed every day, but the CIT basically told the private sector, don't file any more cases. We are not going to hear any cases until this Supreme Court decision comes out, and that's on the basis of the government saying you don't need to get in line. This had to do with this concept of liquidation, that after 314 days, those entries that you go through that formal entry process, they liquidate after that period of time. So this litigation, the Costco litigation and others, was really about trying to suspend that period of time. The government said that's not necessary, and on that basis, the court said don't file anymore. So I do think we're going to have to wait and see what the Supreme Court says to ultimately see where things go on refunds and what companies need to do. So there's a lot of unknowns right now. I do think when we get a decision, there will be a ton of questions. What's the administration's plan B? What does the tariff landscape look like? And what's the process for refunds? And those are all big black boxes at the moment.
Kellyanne, stay close. We might be speaking again on Monday. It's good to see you. Kellyanne Shaw there, the former senior White House trade advisor. You talked about everyone being exhausted. I thought we meant to come into a new year energized for the new year. We've all read the same outlooks. And when it comes to the equity outlooks, tariffs have barely got a mention, barely a footnote in so many equity outlooks for 26.
To the degree that they have any mention at all, this is the year where you have more certainty. This is the year where all of the tariff noise that we heard in 2025 was supposed to end. Do we get a decision starting maybe at 10 a.m. Eastern today that overturns that particular projection?
And the president says he's going to talk about housing at Davos. If the Supreme Court strikes down IEEPA, he's going to be talking a lot more than housing at Davos. He's going to be talking about reestablishing global trade and the fact that he is going to have to go back into his toolbox to renegotiate some of these deals with these countries.
Have to rewrite that speech several more times, right?
Can you find me one person who's not exhausted coming into 2026?
I can't find
it. If you can, please write in.
I think the president. He was doing a Sean Hannity show interview last night, and then 4:19 a.m. he was on Truth Social.
He's a beast. He just keeps going. Futures positive by about 0.1%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira with more. Hey, Yahira.
Hi, John. Russia says it struck western Ukraine using an intermediate-range ballistic missile known as Oreshnik. Ukraine's foreign minister describing the attack near the NATO border as a grave threat to European security. Russia also launched hundreds of drones targeting Kyiv and the surrounding area. Meanwhile, here, a group of House Republicans breaking with party leaders to join Democrats in extending expired Obamacare subsidies. The House passing the 3-year extension 230 to 196. The measure facing steep Republican opposition in the Senate, though defectors hope it pressures lawmakers toward a bipartisan compromise. And TSMC's fourth quarter revenue topping estimates, reinforcing hopes for sustained global AI spending this year. The beat by NVIDIA's go-to chip maker was boosted by demand for its data center chips. TSMC will report full quarterly earnings and a forecast on capital spending. next week. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in the next hour in about 30 minutes' time. Up next, running risk with policy.
We're still materially above neutral in my mind. Every month we come in and the unemployment rate ticks up a little bit and the inflation data sort of seem to be doing a little bit better. We're running unnecessary risks on the labor market by being so restrictive.
That conversation up next with Claudia Sahm of New Century Advisors, live from New York City this morning. Good morning. The jobs number, 1 hour and 42 minutes away. The estimate in our survey, about 70K. Big range if you look through the estimates that we collect here at Bloomberg. The high is 155, the low is 23,000. And if you go through some of the commentary, the focus really is on things like the unemployment rate, as opposed to the headline payrolls number. And if the unemployment rate comes in, there's just an expectation this Fed isn't going to do much at month end.
Yeah, there's a feeling that really January 28th hinges on that unemployment rate getting down to either 4.5% or 4.4%. That means no, they're not going to cut rates. If it is 4.6%, 4.7%, that's almost a green light saying, please go. Regardless, it's going to be a split decision.
Here are the scores this morning. Futures positive by about 0.1%. Around session highs, we're up by 0.25 on the Nasdaq. On the Russell, up by 0.18. In the bond market, lots of conversations about this very, very tight trading range on a 10-year maturity. Yields are higher by 2 basis points. The 10-year 4.1850 this morning. And the surveillance this morning, running risk with policy.
We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is on a weakening path and inflation is an underlying inflation's already running close to our target. Every month we come in and the unemployment rate ticks up a little bit and the inflation data sort of seem to be doing a little bit better. We're running unnecessary risks on the labor market by being so restrictive.
So here's the latest this morning. Investors counting down to the payrolls report out in less than 2 hours' time. The median estimate in our survey coming in at 70,000. The unemployment rate expected to fall back to 4.5%. Claudia Sahm of New Century Advisors writing, the main problem in the labour market is the lack of hiring. That may not spiral into a recession, but it can put upward pressure on the unemployment rate. Claudia joins us now for more. Claudia, a warm welcome back to the programme. It's good to see you. Let's talk about what we could see at 8:30 Eastern Time and how important that unemployment rate is.
Right. No, any question about do we have a problem in the labor market, the answer is going to start with what's happening with the unemployment rate. And it's really much bigger than does it tick back down to 4.5%? Does it hold? Does it it really is looking at the broader trend. We've seen the unemployment rate moving up since the middle of the year. We've seen the unemployment rate moving up over the past 2.5 years at a very gradual pace, right? So there really is an issue. And again, we don't need to see the layoffs to have the unemployment rate come up. It's just this very low level of hiring. And we have not gotten any indication that that's even stabilized at this point. That's really the center of the problem right now.
Claudia, you say that it's clear that we have an issue. What is that issue, especially given the fact that this isn't a monolithic jobs market? You're seeing some pockets of real pain and other pockets of real strength and wage growth.
Right. Well, I would say that we do the slowdown in hiring is quite broad based. We see that in the slowdown in job creation. We have a much more concentrated, healthcare, education. These are ones that not cyclical parts of the labor market really are pulling a lot of the weight in terms of job creation at this point. So, but you are correct that the pain in the labor market has started to accumulate. If you have low hiring, that's going to hit groups of workers like young adults coming out into the labor market. That's where we're seeing some really, large increases in unemployment and, not participating. And that, so the pain is not equally distributed. But I would say that we're seeing a broad swath of lower hiring. So the concern is out there broadly. I don't think we can point to one policy or one event that's really holding back the labor market. It's something much broader at this point.
It seems like everyone's focused on the jobs report that we get in about an hour and a half. It seems like people are talking less about the CPI report next Tuesday. It seems like employment is the primary mandate right now for the Fed and has sort of eked out inflation as the main concern. Do you agree with that? Do you think that's appropriate?
Well, the labor market was definitely what pulled the Fed into action late in the year. Right? And they cut 75 basis points on the funds rate on risk to the labor market. So the Fed has stepped in. They may not have done enough, right? We may see more cuts because of the labor market going forward into this year, but really they've put some effort into easing, the pressure on the labor market. I think what's going to be really interesting early this year, we have some additional fiscal support coming online. It wasn't, the one big beautiful bill wasn't looking forward to weakness in the labor market, but we do have, tax relief coming for households and importantly for businesses. That may be, the support that gets the hiring rate going, but it does give me some pause that right now the problem is not a lack of economic activity and demand. Like we see plenty of consumer spending and business investment. Businesses aren't hiring. So what is it that solves that problem? That's, I think, going to be a really big question. And the Fed's going to want to see how this plays out before they do a lot more, I think, at this point.
If consumers are worried about their jobs and they get these refund checks, does that mean potentially they're going to hold on to them? Or do you think they're going to go out there and spend?
So it'll probably be a mixed bag. At this point, we definitely can see in the consumer surveys, and the New York Fed had another one out yesterday, where people they really understand it's tough to get a job. Like if you lose a job, the chances you assess of getting a job, they're down at very low levels. People still don't see very high, chances of losing their job. Right. Which I think, people are seeing the low hire, low fire environment. So I don't think that you've got this level of anxiety right now. We are set up if the layoffs were to pick up, if you even had some isolated sectors doing more firing, that could change the picture and really have the anxiety pick up. But otherwise, a lot of experience shows us if you put money in the hands of people who've needed a little extra cash, they're going to spend it. Right. So I think there will be some push to demand. But is that what is holding back hiring? That's what's not as clear because this just doesn't look like the typical business cycle.
You wrote in your Substack, the Fed may let bygones be bygones in their inflation targeting approach to monetary policy. Has the Fed just absolutely accepted that 3 is now the new 2?
Well, so when I met with bygones is the Fed they really the 2% target is what they have. They don't look at a price level, right? And try to get the price level back on track by wanting inflation below 2%, right? So they're looking at not the price level over time, but at this, the inflation rate. I still think the Fed is very committed to having the 2% target, but it's clear with, them cutting with inflation still elevated, they are not willing to risk a recession over squeezing out that last bit of inflation. And especially when I think there are some good stories about why there's still some temporary lift to inflation. So it's not that they've given up on their inflation target, but the Fed is paying close attention to what's happening at the labor market at the same time. But it does slow down the Fed's reaction to anything we see in the labor market because they have a dual mandate. So I think that's where just seeing what happens to the unemployment rate today is not enough to tell you what the Fed is going to do at the end of January, because the Fed is paying a lot of attention to that CPI report next week, too.
We're trying to make it simple. Don't spoil it, Claudia. It's good to see you. Claudia Sahm, New Century Advisors. Claudia, thank you. Thank you very much. Mike Gapin of Morgan Stanley making it simple. 4.6% would keep the Fed on track to cut this month.
That seems to be what a lot of people are expecting, that if you do get that creeping up confirmed, then January 28th is a go.
Claudia's right. It's a complex moment.
Of course.
It's more than just about one data point, that's for sure. Up next, we'll catch up with Priya Misra of JPMorgan, Bloomberg's Lauren Dezensky, Kate Moore of Citi Wealth, Daan Struyven of Goldman Sachs. The second hour of Bloomberg Surveillance on this Payrolls Friday. Up next.
Coming into 2026, there's obviously been a lot of optimism.
I like the momentum of the market.
There's no bears when it comes to Strategas.
I have a tough time seeing meaningful broadening in the U.S. equity markets.
I think the long-term trend is quite positive.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 shaping up as follows as we head towards a decent week of gains. Just off all-time highs printed earlier this week. Futures positive by 0.1% on the S&P, on the Nasdaq up by 0.2. What a 24 hours ahead of us. What a week ahead as well. We've got payrolls later on this morning, 8:30 Eastern time. Then we've got Supreme Court opinions, potentially on the President's Liberation Day tariffs later on this morning as well. Sneak peek of next week, CPI on Tuesday, bank earnings, beginning as well.
Yeah, the idea of the read from the corporate world in terms of what kind of health you see in the underlying economy is going to be really key. Look, we're talking about all the headline roulette that's coming out of Washington, D.C. The proof is going to be in the pudding when it comes to the economy and whether the economy is chugging along and whether companies foresee that continuing throughout the year. If so, these gains will continue and a lot of people will be able to look through the noise with a bit more conviction.
And it comes at a time when this White House is really laser focused on the midterm elections and this message of affordability. Yesterday, you had the president saying he's going to tell his representatives, the FHFA, to buy more when it comes to mortgage-backed loans and bonds. They have already been doing this. And I was told by a source last night they're going to take this up to the cap. At the same time, today he's meeting with oil executives. He has a price target in sight for oil, and that's $50 a barrel. And he thinks he can bring these executives on board to go into Venezuela to help that. In the Sean Hannity interview, this is how the president thinks. He thinks oil is the basis for everything when it comes to affordability and inflation. He was saying it's part of the reason why, you put donuts on a truck. You need oil to get those donuts from point A to point B. This is how he's thinking ahead of November.
Can you imagine the communication war rooms that the big oil executives have been in over the past few days? The pressure on them going into this meeting, do you think these guys want to allocate big numbers right now with crude where it is?
Well, not only with crude where it is, but also the potential of losing their investment should there be a change of leadership in the U.S. or elsewhere. We already saw that back 2 decades ago. Exxon's still trying to recoup billions of dollars. ConocoPhillips, same thing. So at what point are we looking at companies that already have been burned, but who also, talking about those war rooms, don't want to get on the wrong side of this president?
That's accurate. But at the same time, those companies, because they knew that they were shut out from Venezuela, decided to go allocate capital elsewhere. Exxon all over Guyana now, which right now looks like one of the best bets because in a geopolitical standpoint, it's much safer. U.S. shale bosses, according to the Financial Times, basically say that this administration is putting American output, which is close to 14 million barrels a day, on the chopping block. Quote, we're talking about this administration screwing us over again. That is the feeling going into this White House meeting.
It's a delicate time for that sector. Let's put it that way. That meeting taking place at 2:30 Eastern Time later on this afternoon. Coming up this hour, Priya Misra of JPMorgan as Wall Street awaits a fresh labour print. Kate Moore of Citi Wealth remaining bullish through the noise, and Daan Struyven of Goldman Sachs as President Trump meets with big oil executives. We begin this hour with stocks inching higher ahead of key jobs data. Priya Misra of JPMorgan looking for a cleaner read, writing the Bloomberg consensus of 70,000 and a decline in unemployment should mean the Goldilocks market pricing of low hiring, low firing can continue. Priya joins us now for more. Priya, good morning.
Morning.
Can the rate cuts continue?
Yes, I mean, if we get the Bloomberg consensus, does the Fed cut in January? Probably not, unless we get some big, much lower inflation. But look at the market pricing. Market's not pricing for the Fed to likely cut in Jan. The market has, though, 2 cuts priced in for the rest of the year. I think that pricing can remain because when we're looking at the totality of data, we're still not seeing hiring. Nothing in the fiscal stimulus in the one big beautiful bill is essentially saying that that companies are going to start to increase hiring. Look at this last week. Look at all the headlines that we're getting. Policy uncertainty is still high. So if hiring stays low and inflation comes down, in our view, you look at inflation across the board, whether it's shelter inflation, whether it's wage inflation, it's all heading lower. As inflation comes down, I think the Fed is going to say, okay, we can start to cut, a little bit more. I think the bar to cut rates is higher, but we do think that the Fed later this year is going to cut 1 or 2 more times. So I think that market pricing of that terminal rate stays. That's essentially what that 10-year is essentially banking on.
What is going to wake up this bond market, this very snoozy, range-bound, sleepy Treasury market?
I think it's great. I mean, interest rate vol has been extremely low. I think the president is focused on the 10-year. He's told us that before. I think what can wake the volatility up would be essentially if we get additional fiscal stimulus, not one big beautiful bill. If you get tariff dividends. Now, I'm not even sure post-AIPA that the tariff revenues will be as high. We do think that if AIPA is struck down, that the president's going to, essentially come up with AIPA-like tariffs under a different name. But, if there's additional fiscal stimulus, yes, then rates can rise. All those deficit hawks can come out. I think that's an opportunity. If you do get interest rates moving higher, any bear steepening in the curve, we would look to fade. I think the 10-year, in our base case, 3.75 to 4.25, I think that's the range we should expect for this year. If hiring continues to be low and firing starts to pick up, I think that's the tail risk here. I think the asymmetry in the bond market is rates are going to go lower. I think that's what nobody's talking about. Remember last year, all the narratives around the deficit, sell America, that's all way behind us. I think now we have to think about the 10-year being in a narrow range, housing affordability is a focus, and the risk is that if actually we start to see the layoffs, then rates can go lower.
So you think that the best part of the yield curve right now is the 10-year?
We do like the 5 to 10 year part of the rate curve. I think the front end starts to get really tricky. You have to have a clear view on inflation in the next month, on the unemployment rate. But when you're looking at the 5-year, 10-year, I think that's the part, number one, that impacts the housing market. That's the one that the president's focused on. That's the one that prices in the Fed to slowly get closer to that 3% terminal rate. So I think that's the one that we have more conviction in, that is likely to stay in a low range. And, I think that's what you own, particularly if you own risk assets. If you own stocks, if you own credit, your biggest risk here is that the economy actually struggles, because there's so much complacency about this Goldilocks continuing.
That makes sense to me. The hedge against some kind of falling off a cliff of the economy or significant deterioration. What makes less sense to me is that the Fed has room to cut rates because inflation is lower, and that will naturally bring the entire yield curve lower because of the wealth effect, because this is going to boost asset prices that much more, which will only encourage people to spend that much more. And you're going to see inflation in some of these higher end items, which is really what's been driving some of this. I mean, how do you square that?
So I think the K-shaped economy, the K-shaped market continues. So to your point, spending and, if people are getting a refund check, they're going to spend it. Asset price inflation can stay high. But what we're looking at, what the Fed cares about, their dual mandate is PCE and full employment. That PCE number on inflation can continue to head lower because that's a function of shelter inflation, on how, housing, beyond housing ex-housing service inflation. Look at those numbers. They're slowly heading lower. The tariff effect is going to go away from inflation by the middle of this year. So I think, if you think about the rate cuts from the Fed, it was inflation in 2024. It was the unemployment rate in 2025. This year, you've got two paths through which the Fed can cut. There's that inflation part. As inflation heads lower, not asset price inflation, but PCE, which the Fed cares about, as we get close to 2, maybe it's 2.5, the Fed will feel more confident. The hawks that have been very vocal that inflation's above target, they're going to then step back and say, okay, we can, maybe neutral is closer to 3 and not 3.5. I think that's the debate we're going to have all year. What's neutral?
Priya, could we get your reaction to the president last night saying he's giving special attention to the housing market and telling his representatives to buy $200 billion of mortgage-backed securities and home loans?
I think it's great. Now, we don't need just one thing for housing. Housing is an extremely complicated issue. If they need to fix housing, they need to fix the demand side, the supply side. I was a little nervous if all we were going to get was on the supply front. Now, I think the president with this latest bit, and this does not need Congress. Now, the $200 billion is interesting. That's the amount that the agencies can buy relative to the cap. That cap can also move higher. I think once they do the 200, the cap can be moved by the FHFA and
I'm glad you brought that up because the cap is $450 billion. They've already been accumulating billions. Right. So this puts us pretty much right at that cap. But I spoke to a source last night and said, well, the Treasury and FHFA tried to lift the cap, and they said no. So if this just ends at the $450 billion, does it really do much for the housing market?
Well, I think if it's 450, it's 200 billion of net demand. And if you think about the mortgage market, the marginal buyer for mortgages is really asset managers. It used to be the GSEs pre-2008. Some of us were around back then. I used to cover the agencies. Then it was the Fed. Then it was US banks. And now if you look at it, the banks are saying after SVB, well, we're not going to touch this. I think that's where the announcement is interesting. You bring a new marginal buyer in, other investors that might have stayed away will say, okay, the government's behind this. The agencies have the ability to buy. I think we can step in. But I will say, you ask about whether that's important. Mortgage spreads can compress. But ultimately, if you look at the mortgage rate, it's the 10-year. That's the much bigger component. We have to keep the 10-year within that range. If the president's focused on housing affordability, so keep the 10-year 4%, 350 to 4, keep it there, and then get those mortgage spreads. We're talking 10 basis points. So, I get excited. I'm a bond person. Every basis point is very important. But I mean, to get 100, you're not getting 100 basis points in mortgage rates because of this. But it does help. Keep vol low and then get some mortgage spread tightening through the
This might just be the appetizer, not the main course. Is the Federal Reserve going to come along for the ride, along new leadership?
No, I don't think the Fed's going to do QE. I mean, there's talk around the Fed doing QE. No, the Fed is going to.
The Fed's working against this effort at the moment, aren't they?
Well, they are letting the portfolio run off. But I think what the Fed did in December, which was to say that let's make sure the plumbing works, I think that's important. They didn't let the repo market freeze up. So, yes, they're letting mortgages run off. The GSEs will easily offset that. I think on the Fed, what we really want is a credible, independent Fed. And I think, we don't know who the next Fed chair is going to be, but if you look at what the Fed's done over the last few months, they have reasserted that they're independent. This is a committee. The chair is important, but it's one vote. I think the Fed is doing, I don't know if it was, if that was an intended reason for them to be as vocal, but they're telling us that they care about their dual mandate irrespective of the chair. I think they're doing their part. They're keeping that term premium lower. Inflation risk premium, look at what's priced into the break-even market. It's low. The market's not concerned about Fed independence, rightly so.
It's pretty anchored at the moment, that's for sure. Priya's going to stick with us. Priya Misra of JPMorgan. As a journalist, you've got to ask the question. I mean, you've got to wonder what the interviews have been like and what questions have been asked of potential Fed candidates?
Literally, people have told us on this show that they should do QE and that they will do QE in order to get mortgage rates lower. So it's not only a legitimate question, I think it's clearly in the ether. It's not priced into the market, which I think is telling that currently market participants do not believe that to be the base case.
I know the first question the president asks, because the only one he really cares about is will you cut interest rates? But I can imagine the follow-up is what else could you do to help the housing market? And he's saying that this is a housing emergency, and this is really, for him, such a focal point going into November. I imagine it is somewhat part of the conversation.
One to watch later this year, maybe. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. U.S. officials are discussing sending checks to Greenlanders as part of a bid to convince them to secede from Denmark. Reuters reporting they're considering payments ranging from $10,000 to $100,000 per resident. In an interview with the New York Times published today, Trump said ownership of Greenland is psychologically important to him. Meanwhile, Paramount Skydance reaffirming its hostile bid to buy Warner Brothers Discovery, arguing it, quote, represents the best path forward for Warner Brothers shareholders and provides a more certain path to completion. Paramount saying the Netflix offer is inferior because it plans to give investors stock in a cable TV spinoff that it deems worthless. And Oregon officials calling for calm after federal agents shot and wounded 2 people in Portland yesterday. The Department of Homeland Security said a Border Patrol agent fired a defensive shot at a vehicle after the driver weaponized it and drove off. The shooting came a day after an ICE officer shot and killed a woman in Minneapolis. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. And more from Yahara later this hour. Up next on the programme, bracing for a ruling.
We're getting rich because of tariffs, by the way. Without tariffs, this country would be in such trouble, as they were for many years. Such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
We might get that ruling later this morning. Up next, Bloomberg's Lauren Dezensky, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. The jobs number a little more than an hour away. That comes at 8:30 Eastern Time. Just got some data from Bank of America, the Consumer Checkpoint Report. One of my favourites. This is for the month of December. The K-shaped economy and consumer pattern persists, but the divide isn't widening. We'll put some numbers on that. Higher income households saw a 2.4% year-over-year increase in card spending. Lower income households saw just 0.4% year-over-year growth, and that 2 percentage point gap between the two groups pretty stable over the past 6 months.
Yeah, the other interesting aspect from this report, and I agree with you, it's really interesting, highlights that even though people were being choiceful or picky or being very aware of the prices, they were buying more goods. It wasn't just an increase in spending because of the ticket items. It was the volume of goods that actually was being purchased. Also, people were actually proactive. They bought it before November, and that's also something that it really accelerated and then fell off heading into the holidays. So congratulations for getting ahead of the game, everybody.
Some front loading.
Yes, exactly.
Some some real front loading. Thanks to Bank of America for that. We'll get earnings from them later on this month, next week, I believe. Equity futures at the moment then positive by 0.1% on the S&P, up by 0.2 on the Nasdaq. Very tight trading ranges in the bond market we can talk about in just a moment. 2s, 10s and 30s. 2s anchored around 350. 10s at the top end of a recent range, 419 on a 10-year bond yield this morning, higher by 2 basis points. Under surveillance this morning, bracing for a ruling.
We're getting rich because of tariffs, by the way. I hope everyone understands that. They hate to report. We're going to have over $650 billion poured into our country or coming in shortly because of tariffs. Without tariffs, this country would be in such trouble, as they were for many years. We have a big decision. Hopefully we're going to get the right decision. It's such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
So here's the latest this morning. The future of President Trump's trade agenda hanging in the balance as we await a possible Supreme Court decision on the legality of his global tariffs later on this morning. Bloomberg's Lauren Dzezinski joins us now for more. Lauren, just frame for us how important these rulings are, potentially later on this morning.
Certainly. I think the clip package does a great job of summarizing that nearly every day Donald Trump is giving a defense of his tariffs. And to a certain extent, he's speaking to an audience of one, which is the Supreme Court justices who really will make or break the fate of this agenda. They're specifically ruling on the Liberation Day tariffs, which were announced on April 2nd in that big Rose Garden event, and markets subsequently tanked because markets were unhappy with the announcement and kind of the gravity of the announcement. At least what we know so far, number one, leading to some of this uncertainty is that we don't actually know that the decision is going to come down today. It will happen on a Supreme Court decision day, or opinion day rather. But that might be today, that might come later next week, so we don't know. But we also know that the previous lower court ruling did say that these tariffs were illegal. Again, these are the specific Liberation Day tariffs. There's other tools in the toolkit. But if we're reading some tea leaves, it may not necessarily be good for Trump for these very specific tariffs.
That last piece of what you just said, Lauren, I think is so important. Forgive me for jumping in. There are other tools. And that's what I want to lean on here. I'll give you the flavour of things on Wall Street, Lauren. The way people are thinking about it up here is that ultimately, whatever happens, if it happens later on this morning, the president's got other means and ways of achieving the same thing. Is that the sense of things in Washington?
Certainly. It's not necessarily as sweeping, but there are other tools. There's the Section 301, there's the Section 232. These are the sectoral tariffs that have to be more targeted and more specific, as opposed to these country-specific tariffs of just, China will get X amount tariff or Canada will get X amount tariff. These ones have to, go after specific sectors. But Trump does have other tools and other opportunities to impose tariffs.
Lauren, thanks for being here. We appreciate it. Lauren Dzezinski there of Bloomberg down in Washington, D.C. Still with us around the table, Priya Misra of JPMorgan. A question we've lent on repeatedly over the past week or so is what is relevant and what isn't relevant to this market? Because that announcement in early April turned out to be an absolute nothing burger by the time we got to the end of the year. What should you be focused on in 2026?
I think you have to be focused on fundamentals at the end of the day. And the fundamentals last year, for example, the reason why we faded all of that Sell America, the fundamentals are that the economy is holding up, the consumer is resilient, but hiring is slow. And inflation, a key component, inflation is heading lower. And that's why from a rate standpoint, that's what's kept interest rate volatility that low. I think if you get IEEPA being reversed, the immediate reaction might be, oh, that's $100 billion of revenues that the government was getting in that have to be potentially refunded. We have to look at how those refunds happen. Maybe that can be slow walk and you have to go through the courts. But if that's the immediate reaction, that's a supply shock that the market might react on. I would fade that. I would say, let's look at fundamentals. Is hiring picking up? That's what we're watching. Is there additional fiscal stimulus that's going to come in and help demand? If that doesn't happen, you look at fundamentals, you look at policy risks. There are a lot of cross currents. I mean, we've got structural positives, AI investment, strong private sector balance sheets, but then there's a cyclical issue as well of this low hiring. So, as we think about markets, I think the risk on sentiment is why credit spreads are tight. That's why we like owning credit, but we like those treasury rates as well as sort of to try and think about a balanced portfolio.
If I were going to put all that together, I would say maybe fiscal deficits don't matter anymore. Is that correct?
I don't want to sound complacent. There is a long-term problem. We have a long-term issue, I agree, on the deficit. Entitlement is really the only way to solve that. We saw DOGE didn't really solve that last year. But I think that's the question of supply-demand meets at a price. Term premium, or how much additional yield we get from extending out the curve, that has gone up. So investors are earning more because we have an unsustainable fiscal trajectory. But look at the rest of the world. And I think, you look at the rest of the world that's actually doing more fiscal easing, where central banks might be hiking. The U.S. is still the place where you've got the growth and the central bank that's still potentially going to cut.
So you don't really attribute the outperformance of U.S. Treasuries over the past 12 months to this idea that you were going to get revenues from tariffs. Is that correct? That's sort of a fiction that was tied to some of the performance?
I mean, it helped, but it was a tiny amount. It's $100 billion. I think it helped calm some of the Sell America deficit. The U.S. is going to default. It calmed some of that down, that we do have tools to get revenues in. But, I took a lot of what happened last year to be this narrative around everyone's going to sell the U.S. to, no, let's look at the fundamentals. The U.S. is still growing really well, and we've still got the deepest, most liquid capital markets. And as that narrative went away, and then we looked at the fundamentals, we realized, okay, the unemployment rate is slowly moving higher, the Fed can cut rates, and inflation is, heading closer to their target. I think it helped, but I don't think just taking that away, especially if to our earlier discussion, it's going to be put right back on under a different name. I don't think it should be a big deal beyond maybe today at 10 a.m. if it is.
Priya, what about a $1.5 trillion defense budget?
So I do wonder, does Congress
what does that do to the deficit?
So I think that is not priced in. I don't think the additional $500 billion is priced in, because the view is Congress going to allow that? In an election year, I agree that was a headline. If you get another $500 billion, if you get tariff dividends, the same tariffs are being used to pay for OBBA and tariff dividends and
a lot
defense.
of double dipping.
Then I think the bond market's going to say, okay, we need to get paid a little bit more to lend money to the U.S. But I don't think the expectation is that he's going to get that $500 billion quickly this year.
Priya, it's good to see you. Fantastic framing, as always. Priya Misra there of JPMorgan on this bond market and how $500 to $600 billion of extra defense spending is not priced in right now.
It's not priced in to the bond market. It is being priced into some of the defense stocks, which is sort of interesting. There's sort of different messages being felt, whether you're on the equity side or whether you're on the fixed income side.
But to Priya's point, it has to go through Congress when it comes to $500 billion. Maybe they're not going to get all of it. But when you think about things like the Golden Dome, the Golden Fleet, they might be able to get some Republicans and Democrats to sign up for that.
It's a lot of spending down in Washington. There's more still to come. I'm sorry to disappoint you if you wanted some responsible budgets anytime soon.
Yeah,
I'm not sure it's happening.
I get the emails from the Committee for a Responsible Budget.
Yeah, it's just
and they're getting increasingly hysterical. Come on, guys, please care. I mean, other people say it's a big economy. We can absorb it.
It's not happening until the market forces it. Exactly. And the market's certainly not forcing it, that's for sure. The jobs number 1 hour away. The estimate in our survey, 70K. In just a moment, we'll catch up with Citi Wealth CIO, Kate Moore, with a look at her top risks for 2026. Plus, Danny has your morning movers. Nuclear stocks jumping with Meta signing new deals to power AI. We're 60 minutes away from the payrolls report, 2 hours away from the cash open. Into that, futures just about unchanged on the S&P 500. No drama this morning. All-time highs earlier on in the week, and we've hit pause on that rally over the past 2 sessions or so. Plenty of disruption coming out of the White House, though, and you see that at a single name level. We'll get to some of those stories in just a moment. On the Nasdaq, up by 0.15. On a small was the Russell, up by 0.2. In the bond market, what can we do to shake this bond market out of a very, very tight range? Yields higher by 2 basis points this morning. The 10-year 4.1850. Some of you looking for payrolls. Bramo is looking for something else.
Well, IEEPA, and whether we do see some sort of overruling of the tariffs, so the Priya Misra really just threw a whole lot of cold water on that thesis, saying that essentially people are going to look past it and it isn't that significant. I will say that longer term, based on what we've heard this morning, if there is a rolling over of the U.S. economy, that will have the biggest effect on yields, and it is to the downside.
And everyone's just looking through this because the president has a number of other legal tools he can use in his toolbox. One of them, Section 338, though, he may run into, this is the one a lot of people are talking about, because it'll be 50%. You can use it pretty bluntly. You don't need an investigation like some of the others. But he might run into the same sort of issues. There might be more legal suits following this when it comes to all of them, but I think the bottom line is everyone expects tariffs to continue under a Trump administration.
A big ruling potentially coming up a little bit later on this morning. As for the payrolls report, the estimate in our survey, 70K. Big range, talked about it. The highs in the 150s, the low around 20-something. The unemployment rate is expected to come down to 4.5%. That's key for a lot of economists on Wall Street who believe that if this Federal Reserve is going to reduce interest rates, you need something like 4.6, 4.7 to keep that door open for month end. As we count you down to the cash open, let's get you some single names. So we're seeing that disruption. Danny has more.
Yeah,
hey, Danny.
We certainly are. And starting with news that we got just over an hour ago, that Meta will be buying a multi-gigawatt deal of nuclear power, making it the biggest investor among the hyperscalers in nuclear energy. It means it's going to be buying energy from the likes of Vistra, of Oculus. You can see the huge gain pre-market there. John, you mentioned the movers in stocks based on what this president has said, and these mortgage companies are exemplary of that. President Trump saying that $200 billion of mortgage-backed bonds would be bought by Fannie and Freddie. He's directing them to do so. So you're seeing those rally this morning. And again, these companies that offer those types of services, Rocket, Loan Depot, Open Door Technologies rallying as much as 5.6%. Finally, GM falling in this morning's trade nearly 2%. Late yesterday saying that it was upping its charge tied to EVs by $6 billion, making the total hit by its winding down of certain EV and battery operations at $7.6 billion. So that is hurting them this morning, John.
Danny, thank you. This is building up to be quite a costly mistake, chasing that EV story for some of these big players.
Well, and accelerated by the removal of the incentive that the government used to provide to buy some of these. And it really kind of raises the question, who is the best positioned, who is less committed to that, will outperform this year.
Another charge. Danny, thanks for the latest. Appreciate it. On our radar this morning, the Supreme Court could rule today on the legality of President Trump's sweeping global tariffs. A ruling against the levies would undercut the president's signature economic policy and could force the U.S. to issue refunds to importers. Elsewhere, President Trump directing Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to bring down housing costs. The president claiming the move will drive down mortgage rates, some estimates suggesting a drop of at least 1/4 of a point. And finally, on deal watch, Rio Tinto renewing talks to buy Glencore, potentially creating the world's biggest mining company with a combined market value of more than $200 billion. The company's discussing a possible combination of some or all of their businesses, including an all-share takeover.
So this is a redux because we've seen this before a couple of times, and now we have some new leadership and we have some new incentives. The issue in the past has always been price. All of a sudden, we have copper at record highs. You have a real incentive for them to go head-to-head with the world's biggest mining company, BHP, and a real question about what will be included in that. You sort of alluded to that. Will it just be copper, or will it also be the things like coal?
I've been covering this story for more than a decade.
Yeah.
Because Ivan Glassenberg started this conversation more than 10 years ago.
Exactly.
Okay. The key part of this time around is what they would do with coal. And I think a big thanks goes out to our team over in London for this reporting that Rio is said to be open to owning coal if it buys Glencore, and that might move the dial to close this deal.
Exactly. This is what will move the dial, because forever Glencore's had these very large, interesting copper assets. Right now, copper is super hot, going to 13K. People see this power idea, this demand for copper, the need for the industrial base and for data centers and the likes. But it's always been, what do we do with those coal assets? But now if Rio's saying we will take them on board, this is really a green light for this deal to go through.
Speaks to the move you're seeing on Glencore this morning. That stock is higher by more than 10%. Watch this space. Let's turn back to markets. Citiwell CIO Kate Moore noting positivity, writing consensus is largely bullish as we start this year. And we're watching several events that could shake confidence in current positions. Kate joins us now for more. Kate, good morning.
Good morning.
Happy New Year. Good to see you. Let's talk about those several events you're watching. What's top of the pile?
Well, I'll mention one of the events, which of course is relevant to what you've been talking about this morning, which is around the IEEPA tariffs, leading to volatility in the market, because many of the consensus views are that we're just going to kind of grind higher over the course of the next couple months. So we're going to watch that, pardon me, very closely. The second thing we're watching is actually the strength of the economic data. So many people are expecting that we're going to have the Fed cutting multiple times. We see, in fact, 3-4 cuts in many people's scenarios over the course of 2026. We actually think the economy is in a very good place, and we're likely to see the Fed pause for a moment as it waits to see what the impact of the monetary policy cuts over the course of the back half of 2025 due to the economy. So I think people may be a little bit disappointed there. And then finally, a big risk that we have on our radar, and it's something we talked about, as you know, so much at the end of the fourth quarter, was what happens if some of the data center and some of the AI CapEx disappoints or gets delayed? You know, and how do we see people hedge those exposures or pull back from some of their concentrated positions in the space? So those are our risks on our radar. But I got to tell you, even with those, we're risk on right now as we start 2026. We have a constructive view on equities. I think that's a fairly consensus view. But unlike some folks that are calling for a rotation or for increasing their exposure to ex-US, I think the U.S. is, without question, the best fundamental house on the block.
I want to get back into that in just a second. A lot of people have come on the show and said it's been a bit like whack-a-mole. It's been an exhausting week. We've had a lot of different headlines. It's been hard to know what to focus on. And Stephen Major was saying on a Sunday, you can think you have to totally overhaul everything. Yeah. And then on a Monday, your outlook remains exactly the same. Totally. So what are you picking up on in terms of some of these headlines that are having specific company moves and potentially could have significant ramifications?
Yeah, I mean, we're kind of fading the specific company moves and trying to look through the noise a little bit. It's pretty hard for anyone to kind of trade against these headlines. And the other thing I would say is around geopolitical risk, right? We've learned throughout many, many years, decades, that the markets price in very quickly a significant reaction to a geopolitical headline and then fade it, right? And so we're trying to figure out now what are the longer term fundamental implications of, you know, some of these changes or some of the invasions the U.S. has been engaging in. And we don't think we're going to see a significant change in the energy environment in the very near term, for example. So we're not actually making any changes to our exposure there.
The one risk scenario is something that a number of analysts have come on today, which is that the economy does start to roll over, that you do start to get some significant weakness as represented in the labor market, which is a reason why today's 8:30 a.m. report could actually be really significant. How are you thinking about this in terms of what's being priced and what isn't in that kind of scenario?
Well, I think people are worried about the economy rolling over because the duration of this expansion has been exceptionally long. And if you think about it, we've talked about this together before. For quarters and quarters, we've talked about the K-shaped consumer, that there are pockets of weakness in terms of consumption, and yet we continue to chug on, and companies continue to spend. And actually, we think there are a number of significant tailwinds, both on the fiscal and, as I was mentioning, the monetary tailwind after the cuts in the second half of last year. But I think people are worried because there is a strong consensus that economic growth, at least in the first part of this year, is going to be strong. And I think they're worried about positioning in the risk on. And also we have a lot of consensus around, short duration positions in the fixed income book. And everyone's kind of trying to test the waters. Our view, though, as we talk to companies and as we hear from them as they've reported or come to conferences and things, is that the labor market actually is in okay shape. We're not going to get mass layoffs. In fact, even if we're slowing down the pace of hiring, it's because we're further into this economic cycle and not necessarily because there's a reason to, significantly change outlooks.
That's one of the key catalysts for today, but the other is going to be the Supreme Court.
Yeah.
And you say that even though people are talking about these other avenues to reintroduce tariffs, there's a number of questions that need to be answered. After this comes out, what would you want to hear directly from the administration to get some sort of clarity on the direction of travel?
Well, we know that tariffs are going to be a tool this administration is going to use for the duration of the term, right? And we've heard a lot of guests talk about that. I certainly agree with that. The question I have is, how long does it take to implement some more of these specific tariffs, and how durable they'll be past this administration? Do we have a one-time shift in terms of our expectations around margins and business models? Does this engender kind of a change and a shift in supply chains? Do we see kind of like relationships changing between suppliers, consumers, and the places that they do business? And that's really hard to model at this point. So it's a risk. I would expect, though, if the IEEPA tariffs were overturned, we'd see a near-term pop in the market. People would have a bit of relief, frankly, for all those companies that face margin pressure over the course of 2025. But I will say, I never want to bet against the resiliency of U.S. large caps who managed through that margin pressure and managed to, cut costs in other places or spread out those costs across multiple SKUs in order to maintain their fundamentals.
Another thing you like, gold.
I do like gold.
As a diversifier.
Yeah.
And my question for you is, a diversifier to what? Equities, bonds, FX? To what?
Well, I can be a bit cheeky, Jonathan, and say I've used the gold as a diversifier in multiple parts of the portfolio. In fact, when we first were starting to add it in 2025, we were really kind of saying, we don't like the role the duration is playing as a hedge or a diversifier in a multi-asset portfolio. And so that was the initial impetus. Of course, all of the fundamental reasons as well, central bank buying, other asset allocators diversifying, questions around the dollar. And actually, as we got through the year and continued to add to our gold position, we were also saying we think there are strong, reasons for people to have a significant exposure there when other assets don't have as much potential upside. So we're using it against risk, we're using it against duration, and we're liking it for the fundamental reasons. We think we're going to see more and more people make this a considerable part of their portfolio over the next couple of years.
Can you just flesh out your point on duration? What you didn't like about it, and has that changed at all? One of
the challenges is, over a couple of the risk-off periods, duration and equities, didn't actually have the same relationship that they had historically. We were watching this and saying, there's plenty of reason, frankly, for the long end to stay higher than it had been, right? We're looking at deficits staying high and going higher, not just in the U.S., but in the rest of the world. That lack of fiscal discipline kind of weighing on bond market participants. And then I would also say that we have this constructive view, which we had throughout the course of 2025, on growth and expecting inflation to be a little bit spicier than the market was pricing in. So those were the two of the kind of the main reasons, the lack of the kind of the hedging properties, as well as the fact that we thought that rates should stay higher for economic fundamentals.
Something else that you've said, which is not consensus, is that you don't think that going outside of the U.S. is a good diversifier, that you think that the U.S. really is going to be the main engine of growth, which is counterintuitive given your call on gold. Can you explain that?
Well, you start the year, and you guys see this all the time. People put out their outlooks, and they say, we're going to diversify against some of the strongest markets. In this case, rotate. But in this case, rotate for rotation's sake is something I just drives me nuts. But in this case, the U.S. underperformed in both local and U.S. dollar terms last year. We know this. And most of that underperformance was, frankly, because other markets had multiple expansion, and they benefited from the weaker dollar. The earnings side drove the majority of the returns in 2025 for the U.S. And so my joke here is that if you want to rotate just for rotation's sake, you should be adding more to high-quality U.S. equities where the majority of the market is being driven by earnings, not by multiple expansion in currency. And you have a lot of people saying, well, Europe is cheaper. We know that European multiples are less than the U.S., but for real reasons. It's around profitability, it's around margins, it's around free cash flow. And that is not a strong enough reason in itself to own, say, Europe. We also are not as excited as some folks are around kind of the fiscal spend outside of defense in Europe, for example. And that is actually fairly well priced, as you guys know, in the market. So we want to stick with earnings, which we think are going to be the driver of equity markets over the course of this year. And we see the best earnings prospects in the U.S. and actually in emerging Asia.
Kate, it's good to see you. A clinic as always. Thanks for dropping by. Kate Moore of Citi Wealth, very much America First. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Colombia's President Gustavo Petro says there is, quote, a real threat of U.S. military action against his country. The remarks suggesting relations have not significantly improved, even after a phone call between Trump and Petro this week, after which Trump said they would meet at the White House in the near future. Meanwhile, President Trump saying overnight he canceled a second wave of attacks on Venezuela. That's because he says Venezuela is working well with the U.S. on rebuilding its oil and gas infrastructure and releasing what he says are large numbers of political prisoners. And Johnson & Johnson reaching a deal with the U.S. government to lower U.S. drug prices in exchange for tariff exemptions. As part of the deal, J&J will offer its drugs to the Medicaid program at comparable prices to other developed countries, plus participate in Trump RX, a website soon to be up and running where patients can purchase medicines directly. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, reviving Venezuelan crude.
We're going to meet with the biggest oil people in the world. They're all coming here. The top 14 companies are coming here. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion.
Big meeting taking place later on this afternoon. We'll get the view of Daan Struyven of Goldman Sachs in just a moment. Live from New York City, you're watching Bloomberg TV. Live from New York City, welcome to the programme. Equities just about session highs, up by around about 1/10%. The main event, at least for the economic data, is later this morning at 8:30 Eastern Time, with the payrolls report just around the corner. And the Savannah's this morning, reviving Venezuelan crude.
We're taking billions and billions of dollars worth of oil, and it'll be hundreds of billions of dollars. It'll be trillions of dollars. We'll be running the oil. We're going to meet with the biggest oil people in the world. They're all coming here. The top 14 companies are coming here. They're going to go in. They're going to rebuild the whole oil infrastructure. They're going to spend at least $100 billion.
So here's the latest this morning. President Donald Trump set to meet with top energy executives as the U.S. aims to rebuild Venezuela's energy industry. Daan Struyven of Goldman Sachs writing, higher long-run Venezuela production further increases the downside risk to our oil price forecast. We estimate $4 of downside to our 2030 base case Brent price of $80. Dan joins us now for more. Dan, good morning. Good to see you.
Happy New Year. Thanks for having me.
Happy New Year to you too. How much pressure is on these executives going into this meeting later this afternoon?
Yeah, so we know that energy affordability and affordability more broadly is a key focus of the U.S. administration going into the midterms season. In terms of the outlook for Venezuelan production, I'd like to distinguish the short term, where there are likely some low-hanging barrels where you can increase production, perhaps in the tune of 400, 500 KBD in the first 1 to 2 years, with some easier fixes, doing some workovers on the fields, fixing some of the so-called upgraders to process the heavy oil, on the one hand, and then on the other hand, more substantial production increases. If you want to go back to production levels from the past, you need substantial investment, you need time, you need incentives, you need guarantees. And I think you need policy clarity on both sides, both in Venezuela and in the US. So I think the probability of a modest short-term increase has gone up over the last week, but I think the probability of a very large increase over the long term is still well below 50%.
There's a sense that right now any additional Venezuelan crude will cannibalize from U.S. oil production and frankly refining as well, both the U.S. as well as Canadian, and it will take away because the Canadian oil tends to be closer to the Venezuelan. How do you see that shifting right now, just based on what the current constraints are?
So, I think that's how the equities have priced it, with some of the Canadian oil producers and U.S. shale oil producers coming down this week, and share prices for the majors that are either producing in Venezuela or have produced in Venezuela, rising. But at the margin, I still think that U.S. shale production is largely pinned down by price, and we estimate, modest downside to prices from an increase in Venezuelan production. So, at the margin, it would be somewhat of a negative to shale production. But big picture, U.S. shale production continues to surprise to the upside. Despite lower prices, we held our Miami Energy Conference in Miami earlier this week, where Secretary Chris Wright also spoke. The message from the producers, the U.S. shale producers, was we keep getting better at producing more oil, even at lower prices with lower cost.
How's Mohammed bin Salman doing?
Saudi Arabia crude production, has been stable, is expected to remain stable in the first quarter of this year based on guidance from core OPEC producers. Our base case is that production in Saudi Arabia will remain stable this year, and that we don't expect production cuts. And so we continue to look for an oversupplied market of around 2 million barrels per day, which explains our base case that prices edge down. We have Brent averaging 56 this year, WTI 52, but with two-sided and wide geopolitical risk. I think as the headlines of the last 24, 48, 36 hours all illustrate, whether it's Russia, Iran, or Venezuela.
Dan, you don't think the kingdom will step in if the president gets $50 a barrel oil, what he's targeting?
So we think that the production increases from Saudi Arabia have been strategic and have largely served internal purposes. I think Saudi Arabia is setting the stage for a tighter market down the road by discouraging shale supply, encouraging
but it's a $40
demand.
gap between what Riyadh and Washington want. They can't budget to $50 a barrel.
So I think, OPEC typically targets market stability. I think Saudi Arabia is sort of maximizing long-term profits from oil production as opposed to short-term prices. Prices in the short term tend to fluctuate. I think they have a longer-term term objective.
Do you think the price could potentially also experience more volatility to the upside if the U.S. continuously goes after these shadow fleet tankers?
I do think so. I think a lot of the geopolitical risks are sort of short-term bullish because there's a rising probability of disruption. But with the U.S. administration's ultimate goal being energy supply abundance and lower prices, often these actions, and I think that's what Iran last summer and Venezuela last weekend illustrated, a lot of these actions are implemented, operations are implemented without disruptions, with the ultimate goal to raise production. So short-term bullish, medium-term more bearish.
Can you put some numbers on the shadow fleet? What kind of numbers are we talking about? What kind of supply does that account for?
Yeah, so oil on water is near an all-time high. Last year in 2025, global visible oil stocks rose by 1.3 million barrels per day. That's almost 500 million barrels. The vast majority, about 80% of those increases in global visible stocks were on water, very often being transported by the dark fleet. I think the bullish argument for the oil market is that inventories in the OECD pricing centers are still low. Positioning is very short. We saw some short covering overnight. But we put more weight on the fundamentals. The market is oversupplied. We think we need somewhat lower prices in 26 to rebalance the market from 27 onwards.
Dan, it's good to see you. Was looking forward to this conversation. Thank you, sir. Dan Struyven there of Goldman Sachs. To your point, there's a big spread between what the kingdom would like to see and what a president would like to get.
It's massive, and this administration has a very good relationship with Saudi Arabia as well as with the United Arab Emirates, but obviously there is a big difference in the prices that they want to see. Their budget is $90 a barrel. The president, according to the Wall Street Journal, is looking at $50 a barrel. In order for him to get that, he would need to extract some more crude from Venezuela, and that's going to take a lot of convincing today with these 14 oil executives going to the White House.
Do these meetings in Vienna get a little bit more interesting now the US has got a seat on OPEC?
Yeah, I wonder if Secretary
joke,
Wright
kinda.
or Secretary Burgum or the president.
Kind of.
Well, remember when the prices went to negative? It was Trump who cut the deal with Mohammed bin Salman and Putin. So he's always sort of had a seat at the OPEC table.
Yeah. Will we have a seat? Will the United States have a seat when President Trump is no longer President Trump? That's my question.
It's a good question. Coming up on the programme, Jason Draho of UBS, the US Interior Secretary, Doug Burgum, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Next hour, it's the big one. Payrolls report just around the corner from New York City. The third hour of Bloomberg Surveillance up next.
The U.S. economy really was massively resilient.
The labor market is a different labor market.
The unemployment rate is moving higher gradually.
It's frozen, but not melting down.
We're going to start to see some signs of the labor market stabilizing over the next several months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 inching just a little bit higher on the S&P, likewise on the Nasdaq and the Russell. In the bond market, very, very tight trading ranges to start the year on a 10-year maturity, and for that matter, over the past few months on a 10-year at the upper end of that range at 418.90 with yields higher by 2 basis points. In 29 minutes' time, it's the main event for the economic data. It's the payrolls report. The estimate in our survey is 70K. The previous number 64. And the hope for a lot of people, hopeful that unemployment comes down from 4.6% to 4.5.
And that's actually what some people would argue is priced into the bond market. The reason why you're seeing yields continuing to creep a little bit higher, and that the biggest risk scenario, at least for bond markets, is for yields to go substantially lower. Citigroup's Andrea Hollenhorst and team just put this out saying they expect 75,000 in terms of the headline number. Yay, right? But the unemployment rate rising to 4.7%. Boo. That means that right now you're going to get a Fed that's going to cut rates later this month. And that's the reason why they're looking at that deterioration being the bigger story.
Used to feel big on payrolls Friday. Big data point, really important, consequential. Commercial break moments ago. Annmarie.
Don't sell me out.
I couldn't care less about the payrolls report today.
I could care. I just want to let everyone know I actually think it's going to really matter. The truth is, in fairness to Annmarie, it has been a very volatile start in terms of news headlines to the year, and I think everyone is pretty exhausted. Nonetheless, the economics will take front and center when it comes to certainly the markets, but also the politics.
So the biggest question for me today is, will the Supreme Court say that the president using IEEPA, his fentanyl tariffs, reciprocal trade levies, do they exceed U.S. presidential power? For me, that is the biggest question today, the most important thing. Then you pile on top of that Wall Street Journal headline just a few minutes ago, U.S. Coast Guard boarded a fifth oil tanker. You have 14 oil executives coming to the White House today with the president trying to cajole them back to Caracas. The president says he wants his representative, Bill Pulte, to buy $200 billion more mortgage-backed securities and home loans. There is a ton of economic news happening right now. So do I care about this job print that everyone's going to come out and say, throw cold water on it and say, well, is it clean? What does it mean for the Fed? Let's wait for CPI and then we can maybe discuss all that.
Tune in, 8:30 Eastern Time. The jobs report just around the corner. Coming up, Jason Draho of UBS Global Wealth Management with stocks trading near all-time highs. The U.S. Interior Secretary Doug Burgum joins us in just a moment ahead of a meeting with energy executives at the White House, and Stephanie Roth of Wolfe Research breaking down the December jobs report. We begin this hour with stocks stalling as investors await a fresh reading on the labour market, and Annmarie too. Jason Draho of UBS Global Wealth Management writing the Fed is still more likely than not to cut rates again in March, and it will probably require more than 1 month of positive labour market surprises to further delay the cut. Jason joins us now for more. Jason, good morning.
Good morning.
You care, we care. Come on, let's make a think of it. All right, the jobs report at 8:30 Eastern Time. What is a positive report? What does that look like?
To me, a really positive surprise is probably something like 120, because the consensus is at 70. There's some higher numbers around 90. I think to really surprise the markets to the upside and get the Fed to think, maybe there's a stronger labor market than we think, probably in the 120 plus range.
120 in unemployment where? 4.5?
Think about the unrounded number was 4.56. So they could take 0.2% from go to 4.6 to 4.5. That's nothing. To go to 4.4 would be something that this is a more material change. So I think those numbers would get the Fed there's something there. A lot of seasonality. We know we'll get kind of the annual revision, I think, in February. The headline numbers are probably overstated. I think Powell even alluded to this in December, which is why I think you need a big number to really have the Fed think, maybe this is not just stabilization, but sort of start to re-acceleration in the labor market.
I can't let go, Annmarie, dismissing this report, because I actually do think it's going to be very important, because ultimately there's a lot of noise, there are a lot of headlines, but the real signal is going to be in the economy. And we haven't gotten a clean read. I mean, how important is this amid the noise of all of the headlines to you as a compass of what comes ahead?
Ultimately, given what we've talked about in terms of all these various factors, when there's so much noise, I always go back to what are the economic fundamentals? What's the growth outlook? What's the inflation outlook? And is it going to be better or worse? And do these developments actually change that in some way? So if we get economic data like the labor market data that says we've gone from softening and weakening of labor market last year to stabilization and potential reacceleration, that kind of feeds into these where the markets were already kind of pricing kind of this growth, run a hot narrative. If we don't get that, I think that starts to challenge it much more so than anything else that we could hear this week.
So what I'm hearing from you, and please correct me if I'm wrong, is that if we get a weaker than expected employment print, that could pose a bigger risk-off move to stocks in terms of asymmetry in how markets are positioned. Is that correct?
I mean, again, it gets into what is the surprise. So if it's 50,000, 40,000, I think that doesn't scare the markets. If it's like 10,000 or zero, that suddenly suggests some of the confidence. I think investors are looking at a variety of labor market data, think we've kind of stabilized. You kind of call that into question. So I think that, again, would sort of spook the markets.
Jason, you're selling me on the jobs report. I'm now a little bit more excited. But I want to know, do you think the shutdown had any impact on this reading we're going to get?
Well, the shutdown ended sort of mid-November. We know that for government employees, that really distorted the November payrolls report, which that's why I think the 65,000 for private sector was really important. I think the question still is, given the seasonality adjustments, other factors, I think there's still noise. And so this is why I think the markets could also sort of dismiss this reprint to some extent. So I'd say it's important, but depending on what your narrative is, you can kind of say, well, we need more data points.
Is that basically what Annmarie said a little bit earlier?
Yeah, this is what now.
Right,
I was
okay.
excited, and now you made me unexcited.
You've got someone back on your team. Can we just figure out the amount of intervention we've had so far this week from this White House? And as an investor, how consequential you think it might be? Is it positive or is it negative?
Well, I think that's a question we're all sort of trying to grapple with, like how much of this is real versus sort of headlines, sort of tweet kind of announcements, whether it is the mortgage, payments, whether it is talking about, defense companies not paying things out. Clearly, if you have a more activist or interventionist policies, then as an investor, as a shareholder, you think, well, do I need to price at a higher risk premium for it? Because I just don't know what sort of announcement will take place that could alter companies' cash flows. I think right now the view is probably still very much these are headline noises, not fundamentals. And you kind of go back to kind of the idea of a Trump put for the equity markets, that you can sort of rattle the saber so much, but not too far. But if that gets questioned, and then that becomes an issue.
The equity market has certainly had a fantastic run. Jason, it's good to see you. Jason Draho there of UBS Global Wealth Management. The president leans on mortgage-backed securities, and what happens? You see these single names that offer mortgages just rip in the pre-market.
There was a real message, though, in what Jason just said, and frankly in the market reaction, which is they see the president's put more than they do the stick, right? Even if you do have the potential caveats around, say, defense stocks, they rallied on the proposal for a budget increase, even if it was improbable that would actually get through Congress. So the stock market's taking the good, the bond market's looking for the bad, but not finding it. It seems like everyone is expecting only the positive, not the stick.
It's a big tasty carrot right now for some of those names at
Yum,
least.
yum, yum.
Let's get you an update on stories elsewhere. I like that, Bramo. I'll let that go.
Carrot cake, maybe.
Okay.
At the top of the food pyramid.
Yes, we can get into that later. I looked at that. It was like a bad time.
Come on. Everyone
would take so long? It's ridiculous.
Sugar on the top, really?
I'm pleased they finally made that move. Okay, let's get you an update on stories elsewhere. Let's do that. Let's get your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. The United States reportedly seizing the oil tanker Olena in the Caribbean. The Wall Street Journal reporting U.S. forces boarded the ship, which was falsely flying a Timor-Leste flag while transporting Venezuelan oil. This marks the fifth such interception of a ship in recent weeks as President Trump aims to control Venezuela's exports. Meanwhile, NASA will conduct a medical evacuation of an astronaut suffering an undisclosed illness aboard the International Space Station. The astronaut, who is in stable condition, will return with the three other members of their mission, which launched back in August. This marks the first time in NASA's history a crewed mission has been shortened for medical reasons. And the college football semifinals kicked off last night with Miami defeating Ole Miss 31-27 in the Fiesta Bowl. Hurricanes quarterback Carson Beck delivered a game-winning touchdown run to punch their ticket to the national championship. Miami will take on the winner of tonight's Peach Bowl between Oregon and the undefeated Indiana Hoosiers. That's your Bloomberg Brief. John?
Indiana sweatshirt in the control room. You've seen that already?
I actually haven't, but I imagine that there are a couple of them.
Big fan in the control room.
Yeah, I know.
Yeah.
Hoosier up, boiler up.
No, that's Purdue. Another school in.
Let's move along, folks.
Yeah, that was
so focus on the food pyramid.
Okay. Oof. Up next, the morning calls. It's me teaching you.
At least
ridiculous.
you tried.
Okay, we'll also catch up with the US Interior Secretary Doug Burgum in just a moment on the meeting taking place at the White House between the president and energy executives.
If you got a strong data release today, something that indicated the economy was much stronger than we expected, I think the cynics out there might question whether the data was correct. I think it's the broader trend that matters. You've got to smooth these numbers out over a period of time. I think the trend and the path is quite clear towards lower rates.
That was the brilliant Steve Major of Tradition joining us out of Dubai a little bit earlier on this morning, anticipating these job numbers at 8:30 Eastern time. The numbers about 17 minutes away. Into that, the scores look like this. Futures positive by 0.1% on the S&P. On the Nasdaq, high by 0.2%. That's the price action. Here are your morning calls. First up, JPMorgan, double upgrading Southwest to overweight, placing the airline on its positive catalyst watch. ahead of earnings later on this month. Your second call from Mizuho, downgrading Qualcomm to neutral, anticipating headwinds to its handset shipments this year. That stock is down by 1.8%. And your third and final call from Truist, upgrading Lockheed Martin to buy, citing fading Doge concerns and strong global demand and the potential for a pretty big budget coming out of the US. Down in Washington, D.C., Lockheed Martin in the pre-market higher by 1.5%. Let's turn to energy. Nearly 20 energy executives meeting with President Donald Trump today to discuss rebuilding Venezuela's oil infrastructure. The lineup includes representatives from Chevron, Exxon and ConocoPhillips, among others. Also attending the meeting will be the US Interior Secretary Doug Burgum, who joins us now. Mr. Secretary, welcome to the programme, sir, and a happy new year. Just frame for us the expectations for today's conversation.
Well, the expectation today is to have a great conversation about the opportunity to continue President Trump's agenda, which his agenda, of course, has been always about the safety and security, national security of our country. That begins with you can't have national security without border security. You can't have national security without energy security. So that's going to be on the table. And, of course, the prosperity of America. That's based on energy as well, because if without a plentiful, abundant, reliable, secure energy, you're going to have the inflation like we saw in the previous administration. President Trump is turning that around. So this is really at the core, it's a discussion about peace in the world and prosperity at home. And what an opportunity, economic opportunity to restore normal relations with Venezuela. And for companies, including many of these that had operations in Venezuela for decades ago, when Venezuela was a big economic partner of the United States before its collapse, get a chance to return to that. So looking forward to it. It's an exciting day and lots of interest in coming to the meeting today. There are not enough seats in the room in terms of executives that wanted to join in the meeting today with President Trump.
Secretary Burgum, I know that you and Secretary Ryder have that outreach with the oil industry right now, but what I'm hearing is that they are certainly lining up for a meeting with the president, but they're not necessarily lining up to go back into Venezuela. What are they telling you?
Well, I think the very strong interest. How can you not be interested in the world's largest oil reserves in the same hemisphere? So I think there's questions, of course, questions about security, questions about what the long-term profile is going to be, but the interest level is through the roof across from the small wildcatter to upstream, midstream, downstream, the majors. There's so much interest in this, and not just in energy. People are reaching out because the mining industry collapsed in Venezuela. Their entire electrical generation industry has collapsed. The opportunity with sanctions being selectively listed for the U.S. companies to sell into that market as it rebuilds is very interesting. And of course, we've got a number of energy companies that have spent their careers going into some of the world's dangerous places to develop oil resources. And those folks, some of those will be in the room today as well.
But it's going to take tens of billions of dollars for them to allocate capital to go back into Venezuela. Does the math make sense when WTI is trading below $60 a barrel?
Well, the market is going to decide, but I know that one thing that happened this week, people keep saying, oh, below 60, there's going to be no interest. Through the Department of Interior, we're holding our as required legal lease sales. The one that we held in New Mexico earlier this week on January 6th, $327 million of royalty payments and a record, the highest since these leases have begun under the new format. Almost 40 years, 39 years ago, in 1987 was when the new rules came in place. It was $219,000 per acre on one of the leases in Permian. So I would say the interest, U.S. And in Venezuela, very strong in this industry because they see, they look ahead and they see the demand for energy going up. And of course, driven by economic growth, 2026 could be a banner year, but also the energy required for us to win the AI arms race. So there's a strong, strong interest in this investing in this Western Hemisphere.
Does the administration have a goal of getting oil to $50 a barrel?
Well, I think what President Trump wants is he wants to break the back of inflation, and he knows that there's a component of energy in the food you eat, the clothes you wear, the car you drive. If you can get energy prices down, that's the best way to lick inflation, and affordability is something that matters. President Trump has stopped the runaway inflation. The prior administration, he wants to keep it going. When we talk about how do we get prices down, part of it is We've cut so much red tape in the last year. We've lowered the break-even point. That plus the technological innovation from this industry, the oil and gas industry, is not what it was 50 years ago. This is a super high-tech industry. You take a look at my home state of North Dakota, and you look at the capability and the productivity increases of the people developing there. It's just been amazing, the gains that they continue to make. And again, the shale revolution, tied with deregulation, cutting some of the red tape that was put in place. We know that their break-even point is getting lower and lower, and that's why it makes it a great industry, and that's why we've got the greatest industry in the country, or in the world, because in the U.S. we've got competition. We don't have a nationalized oil industry that's become a monopoly and lethargic. We've got great companies that get out and compete. We're going to be with some of those great companies today, and excited to hear their ideas about how to go in and break free the incredible opportunity that is for both the U.S. and Venezuela in developing this resource.
Mr. Secretary, a lot to unpack there, including about the shale patch. I do want to stay on this question of U.S. backing of some of these U.S. companies going into Venezuela and building out the infrastructure there. President Trump has talked about potentially a $100 billion investment, potentially over the next 18 months. Where would the funds come from in the United States for some of these energy companies to help back those investments?
Well, the discussions right now have been that the capital is going to come from the capital markets and come from the energy companies. I don't see that these companies are going to need support from the U.S. other than things around security. I mean, if we can provide a secure, stable environment, the resource here is so significant and so large that it's going to be attractive for people to go in and develop that. And particularly as the U.S. maintains the embargo, this is key. You reported on it just now. President Trump, serious. I mean, sanctions under President Trump actually mean a sanction. The failed sanctions under the Biden administration just turned Venezuela and other places into the discount gas stations for China and other countries. And President Trump is, we're going to make sure that this is secure, and we're controlling the flow both of energy going in and energy coming out. Venezuela's heavy crude requires diluent. It requires a light crude like we've got in the United States to go down there. One barrel's got to go into Venezuela for every 5 barrels that comes out. Russia controlled that market. That market's coming back to the U.S. And the synergy between our refinery sector in the United States, which was built around Venezuelan oil, getting back to that's great news for refiners, great news for gas prices for Americans, great news for the opportunity to sell modern equipment to modernize this industry. So lots of news for beyond even the oil majors. Lots of great news economically as we open up this trading and normalized trading relationship with Venezuela.
Yeah, certainly Valero, as a refiner, has seen the benefits of this. Mr. Secretary, you talk about security guarantees, and if the safety is there, the oil majors will go in with, frankly, capital markets behind them. What kind of security guarantees are they asking for?
Well, we'll find out some of that more today, but I think what they really want to understand is, how serious is the U.S. in maintaining the embargo? How serious is the U.S. in maintaining stability in Venezuela? And I think the actions that they're seeing this week speak loudly to that. The actions of President Trump enforcing the embargo and already the cooperation. I mean, earlier this morning, President Trump, just in the last half hour, tweeted out that the Venezuelan interim government is releasing political prisoners. They're taking actions to demonstrate that they want to have a successful economic relationship with the United States of America. The interim government's committed that they're going to be buying equipment and material from U.S. companies. I mean, these are all the signals that we're looking for to keep us moving towards normalized relationships.
Mr. Secretary, as you know, to establish stability in this region, it might require massive expense from the U.S. government, which might require a lot of money from taxpayers. If these oil majors go in with the support of the U.S. government, Mr. Secretary, would the president want a slice of that revenue for the U.S. government?
Well, I think President Trump is always looking for good deals for the American people, but he also is a business person. He understands that we have to have the right economic conditions for companies to go in and deploy their own capital and solve these problems. So I think in the end, what we're going to see is we're so fortunate to have a president who has got the willingness and the courage and the understanding of how to use force, just like past presidents did. I mean, we wouldn't have the Panama Canal without bold action by Theodore Roosevelt 125 years ago. And now under President Trump, taking a corollary of the Monroe Doctrine, which is saying, hey, if we've got criminal enterprises running countries and destroying countries in our hemisphere, that's bad for the neighborhood. Let's go in and clean it up. And do that. But when it comes to rebuilding, I think, again, what we've seen is that if we can create the right market conditions, we're not going to need taxpayer dollars to go do this. And who's going to benefit? The taxpayers, because they're going to see lower prices at the pump here in America.
The reason I bring up this question, sir, is because, as you know, there was some conversation about chips being sold into China and the government getting a share of the revenue associated with those chips. And I wonder if the same kind of thing applies here, because I think the executives going into this meeting later are trying to figure out what kind of meeting they're going into. Is it an opportunity to explore Venezuela by themselves or alongside the US government? And what kind of agreement could be established further down the road?
Well, I think initially it's going to be alongside the U.S. government because, as has been stated publicly this week, the U.S. intends to control the disposition of the oil coming out of Venezuela. And as I said earlier, that it's going to control whatever material and supplies, and in this case, the millions of barrels of diluent that need to go in to extract this heavy Venezuelan crude. That is going to be controlled by the U.S. During this period in cooperation with the interim government in Venezuela. So I think that they can hear more about that firsthand today, but it's going to match what they've heard publicly this week. And I know from talking to a number of these executives this week, Chris Wright has talked to a number of these executives this week, there is a lot of interest in getting back into the world's largest proven reserves right here in our hemisphere. And again, that's a great benefit to the entire Western Hemisphere, but absolutely it's a benefit to the American citizens.
Mr. Secretary, we appreciate your time. I imagine this is going to be an ongoing conversation, and we look forward to exploring the issue with you through 26. A Happy New Year, sir. The U.S. Interior Secretary, Doug Burgum. Without a doubt, these majors are going to be interested going in. Along what timeline? That's going to be the question a lot of these guys are going to have. To establish real stability, you need to see how this plays out for a number of months, don't you? Maybe even years.
Exactly. And the point he brings up is that the questions he continuously gets asked is about security. You want to go back in there if it's stable. Remember, Exxon, ConocoPhillips, they're still owed money from the mid-2000s. But what he says he's hearing from oil executives is very different than what me and other journalists are hearing from oil executives, which they're very skeptical about going back into Venezuela.
Lisa, let's just put it this way. There's a lot of work to be done on this issue.
To even understand the questions that some of these oil executives have that need to be answered by the administration.
Up next on the programme, we'll get to the jobs report. It's just around the corner with equity futures positive by 0.1% on the S&P 500. We're looking for about 70k and an unemployment rate to fall back to about 4.5%. Mike McKee messaged me just moments ago. He said, the last time you wished me a happy payrolls Friday was September 5th. September 5th.
Oh, that's pretty...
It's been a while.
Yeah, well, it's the reason why people are talking about clean data. Do we get it this time?
Crazy.
It
We were doing this on like
5th.
random Wednesdays, weren't we?
Yeah.
Futures look like this. Your scores set up as follows. We're positive by 0.2% on the S&P 500. Likewise on the Nasdaq. Here's a quick picture of the bond market as we anticipate this jobs number. The estimate is 70,000. With the jobs number is Mike McKee. Good morning, Mike.
Good morning, John, and happy December 9th. 50,000 is the change in non-farm payrolls with a net revision to October and November of a negative 76,000. So over the 3 months, we're down by 26,000. Change in private payrolls, 37,000. Manufacturing payrolls were down 8,000. The private payrolls is only half of what was forecast. So this is a bit of a rebound in the government sector, it seems. The unemployment rate, 4.4%. It was 4.6 last month, or well, basically for November, we'll call it. And the feeling was that might round down to 4.5 because government workers who misclassified themselves as unemployed would fall out. But we've gone down to 4.4. Labor force participation rate, 62.4. We'll look into the reasons for the drop in unemployment and see if it fits under the so-called good news categories. Average hourly earnings up 0.3 for for the month and for the year, 3.8%. It was 3.5% the last month. So the president gets something out of that. But a 4.4% unemployment rate on the face of it looked like he's not going to get any kind of January rate cut from the Fed.
Mike McKee, thank you, sir. We'll come back to you in just a moment. So you all remember the routine. The first move is not always the right move. But where's the emphasis this morning? On headline payroll, softer than expected, some big downward revisions, or on the unemployment rate? Coming into this, the view on Wall Street was unemployment at 4.647 keeps the door unlocked nicely for a rate cut at the end of this month. 4.4, does that change the conversation for the FOMC? Yields higher by 3 basis points at the front end of the curve. Two's up to about 3.52. The 10-year bond yield at the upper end of a very tight range for the year so far, 4.19. And in the equity market, I have to say in the stock market right now, pretty muted price action off the back of some of this. Up by 0.2%, Lisa, on the S&P 500.
Right now, at least the initial message from the 2-year yield is that this takes a little bit of emphasis away from the Fed cutting rates at the end of this month. The idea that you got a 4.4% unemployment rate after getting a 4.56% unemployment rate at the previous reading, that was also revised lower to 4.5%. So you are getting a revision lower. You will get some people who will come out and say it's all a noise. How can we really understand any of this? And the headline number was weaker. Nonetheless, on the margins, this doesn't indicate a further deterioration that would really embolden some of the doves to really go aggressively at the beginning of the year.
And Mike McKee, you're still standing closely by. Where would you put the emphasis this morning, looking across this report?
Well, we're going to emphasize the unemployment rate, and I'm still working my way through this, but the Labor Department does say that it adjusted the seasonal adjustment factors that are used in this report for the year, and that may have had an impact on why we see the unemployment rate drop 0.2%. We've still got to see what the overall number is and what the rounding number is, and then we'll take a quick look. I'll take a quick look at what the biggest changes in jobs are. But right now, to say 50,000, that is slower than anticipated, but the unemployment rate falls more than anticipated, and what you end up with is that low higher economy we've been talking about for months.
No real change, as you were. Mike McKee, thank you. We'll come back to you later. As you were for market pricing and Fed cuts this year as well, about 50 basis points, and as you were for Annmarie, who's probably feeling pretty good about herself, given that she wasn't interested in this number at all about 20 minutes ago.
I'm excited now. 4.4%. A lot of people are going to say this shuts the door for the Federal Reserve to have another interest rate cut. Also, looking into this, though, this might become a problem for the administration. When you look at, once again, manufacturing sees yet another contraction in payrolls. They are really trying to sell this message that manufacturing is coming back to the United States. It's where the jobs are. We're just not seeing it show up in the data.
If you are just tuning in, welcome to the programme. So a slight downside surprise on the headline jobs number, 50K, the estimate's 70,000. Lots of focus on the unemployment rate. That was at 4.6, revised to 4.5. It's come down to 4.4%. The expectation today was that it would come down to about 4.5%. If you push this through the equity market at the moment, going into the opening bell, equity futures positive by 0.25% on the S&P 500, up by a third on the Nasdaq. Turn to the bond market. Yields have been bleeding just a little bit higher throughout the session, up now by 2 basis points on 2s to 351, on 10s up 1 to 418. With us around the table, Stephanie Roth of Wolfe Research to kick off the post-payrolls conversation. Stephanie, good morning.
Good morning.
What's your reaction to this? What are you focused on?
I'm focused on the unemployment rate, as is the market. It was a big downside surprise, whether it's seasonals or not. We're now looking at 4.4%, which the risk for this report was certainly that it would be lower rather than higher, but we certainly didn't get that higher outcome, in which case certainly the January cut is off the table. And now the focus is on the labor market is largely pretty stable. And I think that there's a legitimate chance that employment will get revised up rather than down in the subsequent benchmark revisions, which is very different from what, say, Powell has been talking about, that we should think about each payrolls number as 60,000 lower than what is reported. I think there's a chance that it ends up getting revised higher into the future.
So the risk management adjustment of the Federal Reserve is over, that's done, that's behind us.
Yeah, I think that's fair.
What's in front of us? Just a period of stability and going nowhere until we get a new Fed chair?
Yeah, I think that last time was the last cut for Powell, and now we're going to see not much out of the Fed until we get the new chair, and in which case then we'll be in an environment where inflation is likely decelerating in the middle of the year. The bump that we get in the beginning part of the year because of fiscal will start to fade. We'll see a little bit of a cooling in the economy, in which case they can probably cut another couple of times.
Is this clean data?
Yeah, I think it's as clean as the first print on payrolls can be. Because we know that response rates are a lot lower on the first release than the subsequent second and third. So this is clean, unlike the CPI data, which we're going to get next week, which is going to have some significant fallout as a result of the government shutdown. This has largely worked itself out in terms of government shutdown effects at this point.
Do you feel more confident about the unemployment rate really representing something that's going on based on some of the other data that we've gotten this week, whether it was the JOLTS data and the quits rate, whether it was what we saw with respect to ADP numbers, or even ISM services data?
Yeah, I think the collective data is telling us that the labor market is stable, if not starting to improve a bit. Now, of course, hiring has slowed down, but some of that has to do with retail, which seems to be retailers concerned about how the holiday season was going to play out. It seems like perhaps the holiday season went a bit better than expected. So what the collective data is telling us is that we're not deteriorating in the labor market. If anything, you're starting to see marginal improvements, whether it's the quits rate, whether it's the layoffs rate not looking any higher, whether you're seeing claims continue to be stable. All of the data are telling you the picture is that the labor market is largely fine.
Governor Myron was on this week, and he really was talking about the reason why he wants to see lower interest rates. He was talking about what's going on with inflation. He thinks a lot of that has really evaporated. What would we need to see next week in an inflation print for the Fed to consider cutting with a 4.4% unemployment rate?
We're not going to see that next week.
Well, for him to maybe go into the meeting and make that argument.
I think it's going to be a tough one because what we're going to see next week is a pretty decent bounce back in terms of following the government shutdown, because there were a number of cities, about 20% of the metro areas are surveyed every other month. Those that were supposed to be surveyed in October, the BLS put in a 0% inflation for them. So we're going to get a catch up in that. So it is incredibly unlikely that we're going to see a soft CPI print next week. Certainly one that they can make an argument such that the Fed should be cutting as a result of soft inflation.
I believe we get that data this coming Tuesday on the 13th. Mike McKee still with us. Mike, your thoughts on what you're seeing at the moment?
Well, we're breaking down the unemployment rate numbers, and if you start at the top level and go out to three digits, the unemployment rate for December is 4.375. It was 4.536 in November. So this is a significant move down in unemployment. Breaking it down, we see the labor force rose by, actually fell during the month by about 45,000 people in the labor force, and then the household employment number rose by we're calling it 232,000, and unemployment fell by a little over 200,000. So more people got jobs, fewer people were looking for jobs. And so in the parlance of this kind of stuff, we're looking at bad news is good news, and that's why we see the unemployment rate come down. Biggest job losses were in retail, and the biggest job gains, as usual, were in health and social services. The unemployment or job loss in retail is not usually a surprise for December and January, maybe a little bit for December, but retailers start letting people go. We'll see if that continues into January.
Mike, happy Payrolls Friday. It's good to see you. It's been 4 months. It's ridiculous. We haven't done a Payrolls Friday in 4 months. Unreal. Robert Tipp of PGIM joins us now to build on the conversation in the bond market. Robert, would you conclude, established in the same way that Stephanie has, that the Fed here is done, at least until we get the next Fed chair?
I could understand based on the 1 month where you could come to that conclusion. But if you look back over the last 6 months, 12 months, 24 months, there's a linear rise in the unemployment rate. There's month-to-month variability, but the trend there is definitely rising. The wage growth of 2.3% per month is about equaling inflation, so there's zero real wage growth there. So I think for a Fed that really has been very focused on the unemployment rate, they're going to focus on the trend. And I think this keeps us on course for them to continue slowly cutting the Fed funds rate as we go through this year.
Robert, do you think, though, that means later in the year that we end up getting the rate cuts, not necessarily on January 28th?
So I think January, there's a lot going on there. We'll be on the eve of Mr. Myron's term expiring there. They have just moved 3 meetings in a row. And I think that is going to be really important here. And the chair has discussed that now they're on the cusp of or in the top end of the neutral range. So they may feel like they're not having an impact on the economy here. They can stand to skip a meeting. The pace of growth in the economy is fine. I don't think that's the problem. But there is a trend rise in unemployment going on. And I don't think they're going to be comfortable with that. And I don't think we can assume after a big jump a couple months ago that a 1 month drop of 1/10.5 is an end to that trend. So I think they're going to be on course for cautious cuts to ensure the extension of the expansion.
Robert, do you feel like because this wasn't highly conclusive data that would encourage the Fed to cut rates in the next few weeks, that actually encourages your decision to go and buy longer duration bonds? In other words, they're not going to be overly aggressive in terms of cutting rates, and that will allow some of that, or perhaps permit the weakness that you see to really take hold.
Yeah, and I think it is a strategic buy point for bonds. I mean, we're up here pushing 5% in the long-term treasuries. Your long-term credit product have very attractive yields. Your bond market is very attractive. And unlike a couple of years ago when you had an inverted yield curve, you're looking at a 3.6% cash rate that is probably still on its way down. So I think that a number like this, which is a very stable economy, a slow deceleration in inflation probably, Fed cutting rates that people are going to continue to pick away. And I would point out that your money fund balances have continued to rise. So money has been going into the bond market pretty steadily over the last year. People are, getting anxious about their 4% T-bill yields. Now we'll be anxious about their 3.6% T-bill yields. Should be thinking about going out into the market and extending duration. We haven't even really begun to see an asset allocation shift from money funds to bonds. So I think it is supportive of the back end to see this kind of cautious Fed approach to rates.
Robert, are some of these themes, forces, factors unique to the US bond market? Because certainly the performance of the 10-year Treasury was somewhat unique regarding the global bond market in the last 12 months. The drop-off we saw in the 10-year yield is not something we saw replicated in big developed market sovereign debt markets, Robert. What's special, unique about this US market at the moment?
Right. Yeah, this is a fantastic cycle for global bond managers because if you have a central bank clock, and in our recent quarterly, I put a central bank clock there and talked about how, a year ago, everybody was cutting interest rates except for Japan. Now there are a lot of central banks that are transitioning from that, oh yeah, we're done, like the ECB or the Reserve Bank of Australia, and the market is starting to price in hikes. Korea, all around the world, there's been a big shift towards that end stage. And I think that's made markets anxious. For the strong performance the U.S. bond market had last year, it was a weak year in Europe. They just had about a 1.5% return on their aggregate index. But on balance, markets are taking turns kind of leading what is a very slow bull market out there where the bond market is outperforming cash. It's outperforming. Everybody's terrified to be in the market on any given day. But over time, those yields are accumulating into returns.
Robert, good to see you. Smart as always. Robert Tipp there of PGIM Fixed Income. Quick final word from Stephanie Roth of Wolfe Research on this jobs report. Stephanie, what's the takeaway for you? You've had a few extra minutes to pour through this one.
Yeah, I think it's the backdrop is in a labor market that's actually pretty decent. Like I said earlier, there's a decent chance that the hiring environment is actually a little bit better than the numbers suggest. If you look at nominal consumer spending, it would suggest that nominal income in this economy is actually a little bit stronger than initially reported, in which case we might see an environment where the balance is notably better. We're likely to see an environment where inflation picks up in the next couple of prints, specifically this one, and then we continue to have issues with Q1 seasonality, in which case it's likely that the Powell-led Fed is done cutting, and we're likely to get a couple more cuts later this year. But the economy is largely fine. We're going to get fiscal stimulus hitting once we get to tax season, and the tailwinds are stacked with an administration that is doing whatever they can to try to address affordability, which is a very difficult issue to address, but they are certainly going to keep trying.
The next stop for the economic data, inflation data on Tuesday, on January 13th. The numbers this morning, decent. Payrolls growth, OK, but it's better to see an unemployment rate at 4.4 than certainly 4.5, 4.6, 4.7. Stephanie Roth of Wolfe Research. Thank you. Good to see you. As always, let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Just to recap that jobs report, non-farm payrolls coming in at 50,000 for December. That's lower than estimates that called for an increase of 70,000. The unemployment rate ticked down to 4.4%, as you said, with the previous month's figure revised down to 4.5%. The mixed data still shows traders pricing in about 50 basis points of rate cuts for the year, but a near 0% chance for the Fed's January meeting. Meanwhile, Meta announcing new deals to power the company's AI data centers. The agreements could total more than 6 gigawatts of nuclear power, enough for about 5 million homes. Meta says it will purchase electricity from Vistra, Oklo, and TerraPower. The deals would make the tech giants one of the largest buyers of nuclear power among the hyperscalers. And Oregon officials calling for calm after federal agents shot and wounded 2 people in Portland yesterday. The Department of Homeland Security said a Border Patrol agent fired a defensive shot at a vehicle after the driver, quote, weaponized it and drove off. The shooting came a day after an ICE officer shot and killed a woman in Minneapolis. That's your Bloomberg Brief. John.
Yara, thank you. Thanks for this morning. Up next, we'll catch up with Jeff Rosenberg of BlackRock, breaking down the latest jobs report and what it means for this Federal Reserve. Live from New York City, this is Bloomberg.
I'm focused on the unemployment rate, as is the market. It was a big downside surprise, whether it's seasonals or not. We're now looking at 4.4%, which the risk for this report was certainly that it would be lower rather than higher, but we certainly didn't get that higher outcome, in which case certainly the January cut is off the table.
That was the Stephanie Roth of Wolfe Research just moments ago, following the jobs report at 8:30 Eastern Time. Coming in a bit softer than expected on the headline jobs number, but the unemployment rate coming down to 4.4%, and locking this argument that this Fed is not going to cut interest rates at the end of this month. The price action is shaping up as follows: up by a third of 1% on the S&P 500, on the Nasdaq up by 0.4. Some outperformance again on the Russell. The small caps up by 0.5. As we're counting down to that cash open, about 39 minutes away. This is the trading diary. There's lots to get through the next 24 hours. The Supreme Court expected to announce its first opinions of the year, in focus, of course, the Liberation Day tariffs. Then at 10 a.m., we'll also get UMich consumer sentiment. 2:30 Eastern Time, the president meeting with energy executives. A sneak peek of next week's CPI data on Tuesday, plus earnings season kicking off with results from JPMorgan and Delta Airlines. That's quite a week coming up.
Yeah, and really it will be the economy in focus, which frankly should focus all of us, given the sort of pinball that we've been experiencing this year, because ultimately it's all about the economy, stupid.
Jeff Rosenberg of BlackRock joins us now. He's not stupid.
No, I don't mean that to anyone. I mean,
Jeff, thank you, sir. It's good to see you. Bramo's brutal sometimes, Jeff.
Okay,
Thanks
all
for
right,
making time for us. Your takeaway from the jobs report, Jeff, you heard Stephanie. She says the Fed's done, at least under Chairman Powell. What's your conclusion?
Yeah, I think the headline from this report is that it was still showing weakness, but not weak enough to sort of trigger a move by the Fed faster than it was already being priced in. So, I think this report has a lot in there for both sides of the debate. I think there's a big government worker distortion going on here. You see it obviously between the split between the headline and the private payrolls, which was showing the private payrolls is showing some of the weakness. And I think the big headline and what Stephanie was highlighting is really the Fed's focused on the unemployment rate. People are looking at that. There's some distortion as well from government workers coming back in on the unemployment rate, pushing that downward, maybe more than is really going on in the underlying economy. And then the third thing, which we haven't talked about, which I think is really important here, and it's the split between kind of labor markets growth and inflation, is what we saw in average hourly earnings. Now, you always have to caveat your view on wage inflation from average hourly earnings because it can be very distorted. But, it's a little bit of a revision. You see a little bit higher numbers. 3.8 is a good number. And the key issue here is really on the risky asset side of what does the employment report tell us about markets and market positioning. And the issue is real wage growth. And can real wage growth support consumption and take the baton in 2026 from what really supported the economy in 2025, which was the wealth effect. So if we don't have these incredible gains in terms of the equity markets, in terms of the AI continuation, and that's an if, can real wages kind of support the economy and see that rotation? You talked about Russell outperforming here. It's a little bit of, hey, if you see this broadening in consumption being supported from real wage growth, that can kind of be the new story in 2026.
Which is what a lot of people are banking on, the sort of broadening out. And we saw that record high in the Russell 2000 yesterday, even with an essentially flat S&P 500. Are you leaning into that based on the data that we've gotten so far this week?
Well, it's a little early to say this data is enough to reach that conclusion. And I think you have a lot of kind of other issues associated with that equity market rotational theme, which is a lot of concentration and investors really struggling with one of the key issues for the 26 outlook, which is how do I manage my portfolio? How do I deal with diversifying and finding sources of diversification when I have such concentration, 40% of the equity market valuation in the top 10 companies? How do we get away from those highly concentrated names? How do we find diversification in the portfolio? And the broad economic support for that would be coming from this notion that you could have an economy that is spreading out the gains and seeing a broader based recovery. We talk a lot on this program about, kind of the challenges of the K-shaped economy. And do we see some of that support? So a little potential hint, I don't want to overstate that, and to answer your question, probably not enough in this week's data to come firmly to that conclusion, but it is pushing in that direction.
Jeff, I've got 20 seconds. I'm tight for time. Forgive me. If the Supreme Court rules against these tariffs and we find that out later on today, is that a buy of bonds, a sell of bonds, or a shrug of your shoulders and go to lunch?
I think the conclusion here is that we kind of overreacted on the tariff side, right? We overreacted back in April. Didn't seem that way at the time, but the real issue is we've overestimated the pass-through impact of tariffs on inflation. And so I think it's just kind of taken the heat down on the implications for that. So maybe the third answer in your proposal there, it's a shrug of shoulders.
Lunch it is. Jeff, thank you, sir. Jeff Rosenberg of BlackRock. Enjoy the day. Thank you, sir. Thank you very much. You said lunch too. I've got it in front of me.
Yeah, well, I mean, clearly it's sort of shrug your shoulders because ultimately we don't really know what's going to happen with this. It just kind of creates more noise that we can kind of parse through.
A lot more chaos for C-suites that are paying some of these tariffs, and maybe they're going to get reimbursed. But do you even need to get reimbursed if the president is going to put on, a 338, a 232, a 122?
I'll take the safe option. I've got no idea.
Which is the reason
this
why...
This bond market's been so snoozy for so long now.
You'll be at lunch too. I think everyone's pretty exhausted. They're saying, I could just have a nice meal.
Logged into Bloomberg anywhere, of course, all right? Yields up by a single basis point. The 10-year 418. Tune in Monday. Steve Chevron of Federated, Nourian Rabini joins us, Alicia Levine as well, and Torsten Slok of Apollo. From New York City, have a wonderful weekend.